under the garage, slid through, under the hole in the garage door, or the opening in the garage door, and slid right into Charlie, my Samoyed. Now, this Samoyed's so laid back, he just kind of looked up, looked at Putty, and Putty's like, oh shit.
Right.
And Charlie's like, what's up, dude? Laid back down.
That's how Monty is. He's a full-blooded
Well,
pit bull, and their new kitty sleeps on him.
Putty got it in his head he was going to set these Siamese up. So he went out and picked a fight with them, lured them into the garage, and Charlie nailed the shit out of them. This isn't our cat. This is the neighbor's cat.
So he's going, here, kitty, kitty,
Mom and Dad buy a new house. We're moving, right? Last load in the truck. We're getting ready to leave. We've got everything in the truck. And Dad goes to close the door on the topper, and Putty is sitting right on top like, hey, fellas, I'm going. Let's go. I'm ready. Not even our cat.
Wow.
And he's ready to go with
Y'all
us.
had the best kibble then. Got the best kibble on the block.
He was like, yep, where are we going, boss? Because I'm coming.
I just have feral creatures. I have a
Which
possum.
Facebook page is hers?
She doesn't really use Facebook anymore. If you want to,
I got her number.
yeah, you need to text her. When she got her new phone, she couldn't log into Facebook anymore because she didn't remember her password.
Yeah, she always has that problem.
Well, she gets frustrated after 2 attempts. Then she just gives up instead. And it could be that she was just going too fast, that she didn't get the shift key down
Right.
for the capital letter,
That's,
or
well,
this.
I try not to use capitals because the words I want to put in there have the letters I can't see. So.
Or for the special character.
Mm-hmm.
Yeah.
How many times can you guys use a receipt on your bed?
Once.
Once.
And I can't use it.
It won't work on yours?
Nope. Nope.
No, they're smarter than that.
Yeah, we found that out.
I'm under orders. I'm supposed to have you send me the link for fetch. So
Okay, just so you can see, this
What,
came
can you
through.
use a
This
copper,
came through
right?
on Friday. You saw I had
Can you use copper
like what,
right on your
10,000,
copper?
Yes, you
Something
can
like
use
that, yeah.
multiple. Suzanne,
Pardon?
you can use multiple apps.
I
apps.
just
Yes.
have fetch. I'm not familiar with the other ones, so Amy's going to use her copper and
Coin.
When I told you that,
I don't know how
and I'm
to
gonna
use it.
cash it out. First time
Can you
ever
use it,
ride.
can you?
yeah.
I
I
can't
got my
because I'm on those,
53,000
all 3 of them.
What's
That's
the,
equivalent to
okay.
a gift card.
Because I have a stack like this at home, I kept them.
Because
so
they
I'm like,
range
you
from
guys
50 to
use them and
55,000.
Yeah,
I
but
got
you
them.
have to do it within
So,
a certain
yeah.
amount of time. I think
Yeah,
you've got
and then
2
these
weeks
are
or
points
less.
that I've been
These
getting
are
off
less
of one
than
game
2
I've been
weeks
playing.
And I got them in a zipper bag.
So,
and
yeah.
ordered if you want it for the third one.
Yeah, I'm under orders. I'm supposed to have you send me
I
the
could,
link
but
so that
you
I can
said copper.
go ahead and start doing
No,
it.
I
She
use
wants to start
coin
doing it.
out.
Coin
and
out.
fetch.
That's the one
I
that I
wasn't
already
talking to you.
said. No, she said that. That's what
well,
she said.
Somebody said copper.
Yeah, Amy does copper.
No, I don't.
Oh, I thought
It's coin out.
Okay.
So,
I don't even know what copper is.
what is
I
Same idea.
I've never
Just
even
not
heard
as-
of copper.
Not necessarily as good.
which one?
Copper.
I'm not familiar with it. Fetch, there's a game, Hex or something.
The only thing I like about copper is that you can, once you get your points that you need, you load your PayPal.
I only have like 13,000 points. I don't have enough
There's-
to do nothing with right now.
Yeah, and you'll get like 3,000 points for signing up, and I'll get 4,000.
But I've
for
been
referring
keeping
you.
all my receipts. Just even
So I
to
just
the
click
dump.
this link right here.
Got 25 points
Yep,
for
and then
that
download it.
twice.
Install it.
And I promise, it's
Yeah.
legit. If Shane's using it, you can guarantee it's legit. So,
Oh, you
and
Right,
I've cashed out like $500
Because you're
worth
the
of
one
gift
that's
cards.
listening.
So do I click login or just continue?
Continue,
All right, so today we're going to talk about rental real estate royalties and K1. So Schedule
and then you
E
can, yeah.
is basically the subject of the day. Oh, we're going to talk about working with rental real estate, rental income, and rental expenses, deduction limits based on property use,
Yeah.
personal use of a
Okay, so they're
vacation
gonna
home
have
or a
you do
dwelling,
your
that's
email
where it gets really
verification.
confusing. And I don't like talking about it because it doesn't really apply to our type of clientele, but
And then when you scan your first receipt, you'll
We
get
have
like
one
3,000 points, and I'll get
He's
like 4,000
97
points for
years
the
old.
sign of it.
You
Oh,
can
yeah?
now use
He's
it to
really
add social
really
security accounts.
I look at-
yeah, but that's different. See, this one here, personal use of vacation home, this is talking about renting out your cabin in the mountains. Or your your shack at the beach or something like that. Whereas you're going to use it and you're going to have other people using it. That's what it's talking about.
I seen a TikTok deal once, and they said, for 14 days out of the year, and I was like,
Now that sounds more like that.
yeah, they were trying to teach somebody how to scam the IRS. And
That's
get
not
rid of.
really scamming.
It's not, because we already knew about it.
Well, and on top of that, remember there's a slide on here where you're actually going to be allowed free income.
Yeah.
I think that's the point she was trying to make.
Yeah. No, there's a little loophole.
And then you just click on here.
Limits on rental
And
losses, reporting
like
rental
here,
income and expenses,
you're gonna
and some
wanna
other
set up
Schedule
your
E
accounts.
stuff, which
Because
is
anytime you go to sign
where the
up,
K1s
Walmart,
come
it
in.
will automatically pick up your receipts.
Oh, okay.
Like, do you,
we
when
want
you
to
go
understand
shopping at
rental
Walmart, do you
income
put
and
in your phone
expenses
number?
and become familiar
when
with
you're
Schedule E
shopping?
because it's different.
Not usually.
Okay, I do it.
It looks different than C or
Because
F.
it recognizes me, and then I don't have to scan the receipt for that.
But a lot
it
of the
automatically
topics that we're
picks
going to
it up.
cover today, we've
And
covered
I like to piss
before.
the people off at the door and tell
And
them I didn't
depreciation
scan the
is a
receipt.
big thing on Schedule E
So
for
yeah, it'll
rentals.
pick up all your receipts and everything.
Putting in depreciation schedules for the house,
Then
the
you
water
have to
heater,
do
the
a special
dishwasher, the
Remember all
carpet.
I know,
All
right?
that
Can't
factors
find it,
in
so I'll
here
do that. I'll do that
heavily.
later.
For income producing activities where the owner may contribute much less effort to the process. This is called passive activity income, includes rental real estate. Whether or not you're a silent partner or somebody that's just kind of involved but not totally involved, or even the fact that you might not be a real estate professional. And then we have our K1s, the income reported on Schedule K1s from various entities and partners, shareholders and S corps, and beneficiaries of estates and trusts. We'll talk about that a little bit. The income and deductions reported on these pass-through activities will keep their original character, whether active or passive, investment, business, ordinary, capital gain, etc. This is where that loophole that Matt likes to talk about comes through, where, companies don't pay tax. Mostly true, because they pass it on to the shareholders. Companies are just a holding facility. And then they pass on their, especially when we're talking about trusts, the S corporations, which don't confuse with C corporations,
Completely different.
completely different. And partnerships. They're just pass through. They're holding companies. And then at the end of the year, they generate a K1 and everything, all profits, all losses, all income, all expenses are distributed out to the members. And they report it on their tax returns. They pay the taxes. So rental real estate may be residential property, house, maybe non-residential property, office. This is non-residential real estate that we're standing in. Brett doesn't own it. He rents it from the lady that runs the Pokemoto around the corner.
Because she owns it.
Because she owns it.
And even though she's getting income from 3 or 4 different businesses, it all goes on one Schedule C because it's one property.
E.
Or one Schedule E, pardon me.
Yeah.
Because it's
One building.
one building. So she'll add her income from us, CD Trade Post, Pokemon.
So,
Go.
for the
Donation.
last
Yeah,
3 months, is she gonna get to use this
Photoshop.
address as a loss?
No,
Or is it ready to be going?
the repairs that she will have to make to the office to make it rentable, she will be able to use as an
An
expense,
Okay.
unless insurance steps in. You know, because she's got the building insured, so if insurance were to step in, if she files a claim, and insurance steps in and says, okay, look, the damage in here is, we can give you $10,000 to cover your damages, then she would use that $10,000 to cover all of that, and she doesn't claim anything, because she's considered to be
Whole again.
whole again, because
It's not
she's
income,
been
it's not
reimbursed.
expense.
Right. The $10,000 from the insurance isn't income, but she can't claim any of the expenses.
Because Brent has to have insurance here, plus,
Yes, they have rental insurance, yeah.
yeah, so they have double.
And technically, that's available for rent. Leasing agents have been here.
I've seen
Yes.
them.
She just needs to
Fix it.
fix it, which she might be waiting on insurance. Because it's 3 separate claims.
Yep.
Because it was 3 separate events.
Yeah.
Well, I don't see how they're gonna give her for the second two, because it was the same damage.
Doesn't matter.
Doesn't matter. It's
They
the
told me on
fact
my
is,
car they don't do that.
well, but here it's different because each time it was 3 different windows. Okay, 2 different windows and a door.
Yeah.
Generally, the net income or loss from the rental property is reported on Schedule E. Like we said, there's the exception. If you are a real estate type professional, you can use Schedule C, which has its advantages and disadvantages, of course. Advantage, it's earned income. Disadvantage, self-employment tax. There are no self-employment taxes on Schedule E, but it's also not earned income.
One exception. On Schedule E, you have the ability to check a box that says that this property is being used as a business, or the activity is being used as business. So if you've got 15 properties scattered around Wichita that you're renting out, and you're doing that to try to make money, you're putting it on a Schedule E because it's all rental income, but you're doing it to try to make money, so you click, you're doing this activity as a business, that generates the Schedule SE,
Yeah.
without generating a Schedule C.
Well, if you want to talk about exceptions, there are certain K1s that will also be treated as earned income,
Yes.
even though it's using Schedule E.
Right. Right.
Also report on Schedule E the net income and losses you receive from royalties. Yes, Your Highness. No, wait, wrong royalty. Payments received for natural resource rights. Talk to Shannon. From a partnership or as a shareholder of an S corporation. Just a reminder: S corporations are small corporations. They're limited to 100 shareholders or less.
I think so. I think
No. I was going to say, I think Cargill is an S corporation.
Cargill?
Yeah, because they're not publicly traded. Which is not a requirement. But I think that they're stayed within the family. I think they're. I think
Would
they-
Industries be a good example?
Coke Industries would be another. But they're publicly traded. So they'd have to be a C corp.
Okay.
I could be wrong, or I could have old information.
No. Cargill is not an S corp.
Okay.
It is a privately held, family-owned company, and is the largest privately owned company in the United States.
Wow.
Uh,
I would have never guessed that one.
yeah.
But they're not publicly traded.
No.
That's why I was. Part of the reason why I was thinking it was S corp because they kept it within the family.
Can you buy shares of Cargill? No. It's not a publicly. Cargill stock does not exist.
Enter the net result from Schedule E on to Schedule 1, line 5. And here's our overall subject for the day, Schedule E.
Something like Eddie's Toyota.
That's family owned.
Might, something like that might be considered an S corp.
Or it might be a partnership, you don't know.
Yeah, or it might be a partnership.
Yeah, because didn't the Stevens own that one too?
Yes.
I thought so. They also own,
I mean, Spangles for that matter.
Yeah,
Even though it's family owned, they could treat it as an S corp.
right.
Well, Spangles is Renee's, the furniture was Ashley's, and then there's a brother, and I forgot what his was. They each have their own company.
Brandon is the one, he owns Eddie's, but he's got another
Oh,
car
the car
lot
guy,
too.
yeah.
He's got another car lot too. It's Mason used to work for, so.
So we have the Schedule E that we're looking at, and we're going to point out it says properties B, A, B, and C. And so we have individual properties. These are the individual, for most of our people, these are landlords, and we're treating each house as its own entity. Property A is the property on Twin Pines. Property B is the property on Thunder Road. Property C is the property on West 54th Street. And if I need more, just add more Schedule E's. So in the computer, it would be Schedule E2, column A for my next property. Gets a little confusing because I wish Fusion did a little bit better job of identifying, because I have to remember which properties in what column on what schedule. And I don't like that. Make notes.
What's a self-rental?
Where are you getting that off of?
Type of property.
Oh.
Number 7.
Yeah, it says types of property.
Oh, okay.
It says self-rental.
I believe that would be like if you were in the market of like Hayesville rental.
For storage?
No. Rototillers,
Oh,
verticutters, cement mix trailers.
D&D.
Yeah, D&D, another good. Although it's something else nowadays, but
Home Depot does the same thing. They
Yeah.
run out of equipment.
Self-rental is an arrangement in which a business and property that it rents are both owned by the same person.
okay, well I got that one wrong. I don't know.
It is
I thought it was.
It is common for a taxpayer to own an operating business and also own the accompanying real estate. That person has to materially participate in the operating company for the self-rental rules to apply. So,
Matt's car lot.
the lady that is running Pokimoto owns
Yeah,
the
I was gonna say,
building
that would be a
and is
private.
operating a business. She's a self-rental.
If she's charging herself rent.
Right. If she's saying that she's paying that Pokimoto is paying $2,500 a month lease for that spot, she's a self-rental because she owns the business, she owns the building, plus she's running operating a business on the property she owns.
We used to fix the parking lot.
That may or may not be the responsibility of who
Yeah, that
owns
might
the
not
building.
be her.
That might be the responsibility. I mean, she could own the building, but she may be paying a lease for the property itself.
She might not own the land.
Right.
Because I know who was owning the land, and he would be the type of guy to do that. I know
Well-
who the leasing agent was before this,
The,
and I know he owned it.
right. The property that my family owns in Phoenix, they own a block of land. and that's it. There was a car lot that operated there for 45 years. They leased that plot of land from my family. They didn't own it, but they paid all of the utilities on it. They paid the property tax on it. I mean, they paid everything on it. Now, they were reimbursed on the property taxes, but
I'd love to have this redone, but I would rather that she would pay for snow removal.
Amen. Amen to that one. I know Speedy Patch does snow removal, but they do it from a certain point over, so,
Well, just look where the black stops over there.
yeah,
and you pretty much got an idea.
yeah.
There's been times where I want to go, here's $20, just run over here real quick a couple of times.
Exactly.
Right up next to the house, right up next to the building, I don't care.
There you get the plow for Kelly for Christmas.
Actually, last year we just had him run back and forth.
Yeah, we had to pack it all down.
Mm-hmm.
Yeah.
He just drove back and forth and packed it all down.
So you just buy him a plow to put on the front of that truck, and then he can just run it.
That truck is nickel and diming me to death. No.
All right, so, and then our Schedule E goes to Schedule 1, which you might have a positive or a negative number. Do not use Schedule E to report rental income of the rental of personal property such as equipment or vehicles. If you're in business of renting such personal property, use C.
Yes.
If you're not in the business of renting personal property, Schedule 1, line 8I, which is other income.
Now, if I owned a storage facility, like U-Store, where people come in and rent storage units from me, I put that on Schedule E or Schedule C,
That's E,
running as a business.
because you're the use store. Now, if you have the garage out back that you're just renting out to somebody else, you
That would
might-
be Schedule E too, though.
most likely, yeah.
You buy, you store it lot. You've
Right.
got 300 storage units that you're actively renting out to individuals. You're collecting a monthly rent for all of them. You're obviously running it as a business. You're running it to make profit. Would you put that on a Schedule C and just lump it down as you store? And this is my income from it? Or would you put it down on Schedule E and list 300 individual units?
I wouldn't have to break it down into individual units. I mean, okay, because let's take your argument and change it to an apartment complex. Do I want to list, 6 different apartments? 12 different apartments? 24 different apartments?
Wouldn't have to, as long as the rents were all the same. But if my first floor
Fine.
apartments were 3-bedroom, my second floor apartments were 2-bedroom, and my third floor apartments were 1-bedroom, and I'm renting them out for $500, $750, and $1,000,
I don't think I'd have to worry about making a differentiation on
you
that.
don't think so?
No.
Okay.
No, it'd be more of a pain in the ass when you started to have to make repairs.
I mean, because you wouldn't necessarily you wouldn't depreciate each individual apartment. You depreciate the entire building as a whole.
Right.
So,
And so I wouldn't break down the individual apartments in the building. So like where Jayden used to be, it was building A, building B, building C. I would keep those separate.
right. So,
But
if
the
I-
fact that there was 6 apartments in building A, I don't think that I would keep the apartments themselves separate. It's just
well, no,
building
because
A.
you'd be able to attribute any repairs or maintenance to an individual building.
Right.
So if you had a property and you had 8 buildings on it, building 1 through 8,
Mm-hmm.
you would do a separate Schedule E for each of those buildings.
Right. Well, now I can make an argument back the other way to go back to the original one. When's the last time you saw you store it be one building? It's not.
Right. No,
it's
it's not.
3 or 4 or sometimes 6, 7, 8.
Right.
It just depends, and sometimes it's not even a building. You just rent it off that place over there by the fence, and you park your RV there.
Yeah, or a big pole barn looking thing.
Sometimes, well, at least that's a building.
Yeah.
The heck, I mean, a lot of those places don't. I mean, there's just here's some open spot. You want to park your RV, you want to park your boat, put it right there.
Yeah.
I'll charge you $50 a month. You know, what have you.
Yeah.
Of
Okay.
course, I don't have utilities. I don't. You know, it's just land. I can't do anything with it except make money.
Yeah.
Can't depreciate it.
You're gonna show an income. You don't have any expenses other than property tax.
Well, I will say I might have a little bit of expense because I might have. It might be just gravel, so I go out there once a month do some roundup.
Well, yeah. Okay, so you do that. You maybe replace the gravel, come have it graded.
Yeah,
Uh,
every couple of years. Yeah,
you know, maintenance on your fencing, which you could depreciate.
yeah, but that would be the entire complex.
Your-
So it's gonna be
your-
its own property.
Your electric gate to get in and out.
Yeah,
The software that you know.
there's all sorts of little
Yeah.
itty bitty things you can nickel and dime yourself to get. Would it be wrong to throw it under one property?
No.
Not really. Would it be convenient? Not necessarily. Would it be wrong to break it down? No. Would it be convenient? No. Because, you know, you just mentioned 3 or 4 things that are for the whole entire place. The security gate and the security fence.
Yeah, assuming that it's all linked.
Yeah. That's going all around my 8 buildings that I'm doing separately. So now what? Do I attribute 1/8 of the cost to the different buildings? That's a possibility. It's reasonable. You could.
You could.
So
Or
there's options.
You could. Or
The
you,
point of this whole discussion is that there's no one way.
right.
There are all sorts of different ways to get to the right answer.
If you
It
rent,
just depends on what you want to do.
if you just rent it all as one property, there wouldn't be anything wrong with doing it that way.
Yeah. And if you wanted to break it down into the different individual buildings,
It wouldn't be wrong.
if you wanted to break it down into the individual sheds or apartments, you could. But that would be really tedious.
Yeah.
I mean, especially when you have bigger, a big complex. Would it be a wrong answer? No, but would it be the best way of doing it? Probably not.
Right.
Royalty income from wells, mineral deposits, and various natural resources also show up on Schedule E. They're coming to you on a K1. Maybe a 1099 miscellaneous? Possibly. It's possible.
Self-employment tax from rental would can come and sometimes does come on a K1.
Well, royalty income, so like for instance, when I do Jones and Jones, which actually is a partnership, but they get a 1099 from the oil company.
Yeah.
Jones and Jones Resources, which is the middleman that they set up, but then Jones and Jones Resources paid Daryl Jones and his mom. That's the partners.
Right. Right. The oil company paid Jones and Jones the partnership,
Yeah.
and the partnership pushed out the money
Pushed out the K1s
to the two partners.
to Jones and Jones.
So the partnership doesn't owe any tax. The money owed on the taxes earned by the partnership go out to the partners, and the partners pay the tax that is owed that was paid to the partnership. It gets really, really weird sometimes.
Yeah. Especially when I'm the one making the K1.
Well, my partner, my
Yeah.
car dealer, the two partners make deposits into the partnership account for the properties. Out of that account, they pay for everything that they need for the properties. There's no income on that property. The amounts that the partners contribute back to the partnership are listed as cash contributions for that year. So it ends up raising the basis of the amount that they have invested in the property. And then when they take their loss, it reduces the amount of the basis they have in their property. They don't ever show any income in the property because there's no income. They just contribute X dollars to the property and then take their losses.
Do not report royalties for services such as artwork, intellectual material you have created,
Okay.
books, publications, etc. on Schedule E. When your efforts rather than your investments are generating the income, generally those types of royalties will be considered income. Self-employment tax will be reported on Schedule C. Net earnings will be subject to self-employment tax. So when Stephen King gets his royalty check for selling copies of It,
We can keep it.
that's a Schedule C.
I don't like the clowns.
I just brought it up because Netflix has a new series, so. Not that I've ever watched it and I've never read it, but not my thing either.
The guy that did did he just recently pass in the last week or so?
Not that I know of.
Because I've seen a lot of tributes towards him.
He had a stroke, but as far as I know, he's still living.
Carrie, something, Curry, Tim Curry.
Tim Curry, also the original Frankenfurter.
Yeah. 'Cause I've just seen a lot of.
I seen a recent interview because this was the 50-year anniversary of the movie for the Rocky Horror Picture Show.
Oh.
And so
That
he'd been
could be what it
interviewed a
was.
few times recently. Schedule E, report all the rental income for the tax year as well as related expenses including depreciation. You're going to be taxed income-wise on your net income. If you have a loss, there are special passive activity loss rules which may limit the amount of loss that you can claim this year. But you do get to carry it over to future years. There are also special rules related to expensive property use, partly for business, partly for personal. Well, that makes sense. Rental income is any amount you receive for the use or occupation of a property. In addition to normal rent payments, other amounts may be included in rental income, including advance rent. You pay the first and last month's rent. Well, that's rental income.
Unless they list it as security deposit, then they don't have to list it as income when they receive it if they intend to give it back to the renter.
That's not income at all.
It's not income at all. Doesn't even show up.
Until the determination is made that you don't get your security deposit back.
Yes.
Then it becomes rental income.
So when you move out of your apartment and your cheesy landlord comes in and goes, "Oh my God, there's $1,000 worth of damage. I'm keeping your $750 deposit." It now becomes income to him, and he will miraculously come up with $1,000 in things that he needs to do to your apartment that he gets to write off of that $750 income that he now.
Judge Judy, because she will.
However,
These great.
if you manage to return your apartment in pristine condition and you get the rental or get the security deposit back, it is not an expense to the landlord.
Nope, because he's never logged the income.
Yeah, it wasn't reported as income to begin with because the possibility that it was going to be returned
Do they hold
existed.
those normally in a separate account than any of the other received monies?
No,
No.
Or they just
just keep track of it in the ledger.
log it?
Yeah, they just put it in a ledger. Suzanne paid $500 security deposit. When she leaves, everything was fine. Returned $500 security deposit.
Right. Or forfeit $500 security deposit
Yeah.
and then transfer it to income.
Yep.
Payments for canceling the lease early. Payment for expenses paid by a tenant. They didn't want to wait for you to replace the dishwasher, so they replaced the dishwasher themselves, sent you the bill. And you paid it.
But you don't get labor on that. All you get are parts.
It depends.
It depends.
You pay $1,000 to replace the dishwasher in your apartment because I'm in Greece for the month and I can't be bothered to answer your email. So you replace the $1,000. I get back and you're like, here's my bill for the $1,000 I spent to replace your dishwasher. I say, cool, you owe me $500 a month for rent. I'll just take this off your rent. It's income to me for rent. So I log the $1,000 as rental income for the next 2 months, and then I turn around
And
and
expensive.
expense it for the $1,000 repair that I made to your apartment. You don't pay rent for the next 2 months. You have a brand new dishwasher. I have to tell them that I accepted your $1,000 of the dishwasher in lieu of rent, and then I turn around and say I replaced the dishwasher for $1,000.
Yeah. So not only did he get to, he reports his income, then he turns around and expenses it or depreciates it, depending on what we're doing.
Yeah.
He could depreciate the he could depreciate. Well, technically, he should depreciate the dishwasher,
Should, yeah.
but he could take a special depreciation on it. So.
And get the whole thing.
And do the whole thing. Fair market value of property or services. So I'm going to live here, and then in exchange for lower rent price off the top, I'm going to be the guy who goes out and mows the lawn, shovels the sidewalk.
Your super would be a good.
Your super. Yeah. Just make sure that the super reports it as income, or I refer you back to that episode of Mom.
Yeah.
Portion of security deposit you do not return to a tenant. Security deposit intended to be the last month's rent are all considered rental income. If the tenant pays to cancel a lease, the payment is considered rent. Include the payment in the year that you receive it, regardless of your accounting method. So I was in the apartment because I was there repairing the dishwasher, and I just happened to be glancing around and realized that you've trashed this place. You still under the lease for a little while, but I've determined right now you ain't getting that security deposit back. That's the month that becomes rental income.
Yep.
If the tenant pays any expenses such as property tax payment, the payments are considered gross income. Considered income must be included in gross income. If the expenses are deductible, then deduct them from gross rental income. I refer you to what Matt said. But I mean, property tax, yeah, sure. If you're renting a house, you might take care of it in exchange for, okay, I'll pay the property taxes on this, and those couple of months will be a little cheaper. So January, Carrie Ann signed a 5-year lease to rent out her property. At the time, she received $6,000 for first year's rent, $6,000 for last year's rent. This year's income is $12,000. Some rental income might be reported on a 1099 miscellaneous. Rents in box 1. Report the rental income in the year that it was actually or constructively received. Income is constructively received when it is made available to you as such when it is credited to your bank account. So cash basis, basically.
Yeah. See that a lot for your windmill people. Farmers that allow the windmill companies to come out and put a windmill up. The windmill companies lease the land from the farmer. We'll get one of these for rent.
Another place where you might get this is that the guy owns the property, but he doesn't want to mess with it, so he hires a company to take care of it for him. They collect all the rents. They make sure, they take the call in the middle of the night that the water heater sprung a leak. All he does is just wait for the check.
Oh, yeah.
And he gets a 1099 miscellaneous.
Yeah. You have 15 properties around Wichita. You don't want to mess with it, so you hire my management company
Yep.
to manage it all.
That's what my daughter has, the house she rents.
Yeah. At the end of the year, I will
Hey.
send you a 1099 miscellaneous for the rent that I have sent to you.
Right. Which is subtracted all my fees and all that other stuff.
Yeah, they just have their walkthrough on
So,
Might have my fees subtracted off.
problem.
Usually does.
Usually does.
Send a itemized sheet with it.
And it might. Matt's right. I mean, here's an itemized sheet. Okay, here's the income, but here's the expenses. Make your own schedule E.
Yeah.
It could go either way. Fair market value of property or services provided by the tenant as rent instead of money must be recorded as rental income. That's your super. You can live here rent free as long as you're the guy who answers the phone call in the middle of the night that the hot water heater sprung a leak and you got to go fix it. They don't call Ready Rooter, they call you. If you don't call it Ready Rooter either, you go fix it. That's your job.
Yep.
I'm sorry, late arrivals just aren't. If the property or services are provided at an agreed on price, that price is the fair market value unless there's evidence to the contrary. And most of the time it's going to be that. Whatever you agreed on was the fair market price, unless for some obvious reason it is way below or way above what a normal apartment, house, whatever, would go for in that neighborhood.
Yeah.
So I can't make an agreement with the super that I'm going to charge him a real low amount of rent and think that I'm going to get away with it. The IRS is going to figure that one out.
Yeah.
If the amount received as a security deposit is intended to be used as final rent, it's advance rent, included in income when you received it. Do not include amounts that you plan to return at the end of the lease period. If all or part of the security deposit is kept, because the tenant did not live up to the terms of the lease, include this in rental income. And the year it was decided that the amount will not be returned. You don't wait till the end. It's just that as soon as that trigger is pulled. I found out you have a dog in here, and I have a no pets policy. Sorry.
They keep the whole thing.
Could I run a super as an NEC?
Non-employee compensation? Well, yeah, you could. Because he's working for you. Well, but he's not, I mean, you've contracted out all the repairs to the building to this guy.
Right.
So, yes, he's a subcontractor to the apartment complex. And the compensation is his rent, or maybe a little bit more. I mean, it just depends, I guess, how big the complex is and how much work he's got to really do. Because there's got to be a point where, diminishing return says that not only does he get free rent, he should also get paid. There's got to be a point where that exists.
Right. I was just curious because I mean, if I had an apartment complex with 30 units in it, and I find somebody who's qualified in facilities maintenance, they can do the plumbing, they can do the electrical, they can do the carpet, all of that stuff, and I offer to give him an apartment plus $700 a week compensation, and he is the building, he takes care of everything. Even if I give him a corporate card to buy materials with,
Right.
can I still list him as a schedule or as a 1099 NEC as a subcontractor
Yes, because
or
you're
an
not.
independent contractor?
You're not. You haven't met the threshold for calling him an employee.
Because I don't tell him you have to be at work at this time for this, do it this way,
Right.
and that.
You're not on duty 9 to 5. You're on duty. You're just on call. When you decide to actually do the job, it's like, okay, that's up to you. You could show up in the middle of the night, spin the water valve and turn off the water, and then go back to bed and deal with it in the morning.
Right.
I'm not going to dictate. Well, you better head off to Home Depot right now. Well, they're closed. Well, no.
Right. Okay. I'm just curious if you'd have to, if you could do them as an NEC or if you'd have to list them as an employee.
I would figure that most of them are going to go NECs. Because I don't care what you wear, you know.
Yeah.
I'm not telling you how to do it, just get it done.
Right.
And, you know, as soon as possible, but I'm not demanding that it must be done by 10 o'clock the next day or they get their pizza for free.
Right. Okay.
So for Matt's example, we have Larry Landlord. He rents apartments. For 2024, he paid a lawn service company $1,200 a week to do yard work and plow. 24, he agreed to have one of his tenants do this in exchange for rent, which reduced cash paid by him $1,200. Mary Les now include the $1,200 in gross rental income, and he can deduct $1,200 as an expense. He's receiving $1,200 in services, but then he can turn around and expense that same $1,200. Since this is $600 or more, he must give his tenant a 1099 NEC.
Okay.
Showing $1,200 in box one, the tenant will have to show this income on his Schedule C.
That's his only NEC income. He won't be showing it on a Schedule C. Not with
Probably
me,
not.
he won't.
No, because he's not really in business.
No. There's going to be other income.
He's going to be other income. Generally deduct ordinary and necessary rental expenses in the year that they are paid. If the property is held for rental purposes, you may be able to deduct rental expenses for managing or maintaining the property while the property is vacant. Couldn't find anybody to move into it this month because it was just a bad month to go renting out. But it was available, and I kept the lights on and kept the heat going because it's December and I didn't want the pipes to freeze. That's reasonable. It's necessary. I get to keep writing off those expenses even though I had no income for that property for that month. That's not a problem.
As long as it was available for rent.
Ordinary and necessary pre-rental expenses can be deducted during the time the property was available for rent. Expenses incurred during periods while the property was not available for rent cannot be deducted until the property is sold. You cannot deduct any loss of rental income while the property is vacant. So I can't write off the fact that I didn't receive any money. That's not an expense.
Had my house available for rent $500 a month, nobody bought it, I need $6,000 off because that's the rent I lost last year.
Well, since this is a cash basis, you didn't receive any income, so you have no income to report, so you have no expense. I mean, you got your credit,
Yeah.
just not the way that you want it.
You just don't get an extra $6,000
Yeah,
to
you're-
take off of something else.
Yeah, you're trying to double expense,
Yeah.
and that's not allowed. So these expenses must be capitalized or added to the property's basis. That's what I did with the guy that was remodeling the Thunder Road property. I capitalized it. I didn't add it to the basis. I capitalized it.
You amortized it.
No, same idea.
Same idea.
That way, when it finally became available for rent, I started depreciating over 180 months.
He gets it back.
He gets it back. He just didn't get it back the way he thought. He thought that, oh, I paid for that sheetrock right now. I get to write it off. No, you don't. Yes, I realize you have other properties that are making other rental income, but according to the rules, this property is not available. This is the property you bought the sheetrock for. I can't expense it.
The only way you can expense it is if you have your own remodeling company.
Yeah, then I could
The
write it off on
remodeling
the
company
Schedule
bought
C.
all of the sheetrock and whatnot to remodel the house. Then the remodeling company can expense the sheetrock.
So Roland had a house. He's going to use it as a rental property. He bought it in June. Again, advertising for tenants immediately. did not rent the house until September, he can deduct his ordinary necessary expenses for managing and maintaining the property starting in June. Cannot deduct the rent he did not get while the house was vacant for June, July, and August. Of course, he's also not reporting his income, so he's already accomplished that. So let's go back. Let's just talk about some things everyone could take off. Property tax, if you had to pay it for that month. Utilities. Yard maintenance. Heck, if he called Stanley Steamer and had him go in there and clean the carpets, you can write all of that off as an expense right now.
Yep.
Because it's available to rent.
Had somebody come in and redo paint the outside of the house,
Inside of the house.
inside of the house, outside of the house, any of that, as long as it was available for rent.
The fact that he might, if he painted the inside of the house, you had to wait 2 days, that's not relevant.
Nope. It was still available for rent. I could have gone in and agreed with him to rent it, and he would have simply told me, "I'm having the inside painted. You can move in on this day."
Yeah.
It's still available. We still signed a contract.
Yeah, it's still available. The fact that I can't move in until 2 days from now, not relevant.
Yep.
If sometimes use the property for personal purposes, the expenses must be divided between rental and personal. Also, your rental deductions may be limited. We'll talk about that in a little bit. Rents that the tenants did not pay cannot be deducted as an expense. You got stiffed, and then they ran out on you. You can't break that off.
But the fees
Because we're sitting here and you're not reporting the income. You already are recording the loss, just not directly.
But the fees you pay to the lawyer to go after them for the rent that they owe you, you
You can expense that.
you can expense that.
Legal and professional.
On an eviction, then you can
Yes.
expense the legal fees.
I can
Yes.
expense the legal fees all the way down to paying the sheriff to come throw them out.
Yep.
All of that I can expense. Heck, even if I just have a lawyer on retainer.
Yep.
I can expense.
As long as that lawyer is on retainer specifically for your rental activities.
Yeah.
If that retainer includes him as a personal lawyer, then you have to then you have to separate out how much of that retainer goes towards your rental activity and how much of that retainer is for your personal.
Right. Which is only logical. I mean, let's face it. We've talked about those types of things before. We mentioned it kind of right here. So, I mean, that follows. It tracks with other information that we've been exposed to.
Kind of like mileage or vehicle expenses.
Albert rents a house to Jim from October until December. Jim didn't pay. Albert can't deduct the $1,800 that Jim didn't pay him. Of course, he's also not reported it as income. So, I mean, in one regard, no harm, no foul. Yeah, I'm sorry, you didn't get paid $1,800. Maybe you'll get it next month. Who knows?
Yep.
I don't know. The cost of repairs to the rental property is deducted as an expense. Remember, improvements are not deductible as an expense. They must be capitalized and depreciated, depending on what it is. If I add a new garage, if I add a new room, that's going to be at the property rates. If I put in new carpet, if I put in a new dishwasher, that's at the category rates. So carpet's a 5-year property, the dishwasher's a 7. And I can take specials on those. I can't take specials on the new room I put in or the garage I built.
No, those you will end up adding to the basis of the property.
Right.
So if you had a 1-car garage on the property that you're renting and you increased it to a 2-car garage, whatever you spent on that increase is going to get added to the basis of the house, and it'll be depreciated over the depreciable life of the house. They'll capitalize it.
So
basically.
repair is keeping your property in a good operating condition, is not materially add to the value of property or substantially prolong its life. repainting your property inside or out, fixing gutters, plastering, replacing broken windows, are all examples of repairs.
Kind of dumb question.
No such thing.
So would you have to like hire, like an appraiser once a year to like assess the value if you would like to add on a garage or something?
Do I have to? No, and I don't even really have to do that because if I decided to add add a garage, I'm not really worried about what the appraiser says. My new basis is what the contractor charged me.
Okay. So it's just an easy thing to.
Yes.
Yeah.
Now, if I really want to disagree with that and say I think that that the new garage, although I only paid $20,000, I think it added $30,000 of value, and I want to hire an appraiser to prove that because I'm basically getting ready to sell it. That's the only time that you would consider doing that. Otherwise, why give the taxing authority more ammunition to increase your property tax?
Yeah. Yeah, because don't forget when you get a property tax receipt, it's going to tell you what the appraisal
value.
amount is and what the assessed amount is. And if you turn around and hire an appraiser and you say, well, I spent $20,000 on a garage, but my property is actually worth $35,000 more, that means the assessed value goes up, and that means your appraised value goes up, and that means your property tax goes up.
No, you don't want to do that. Now, like I said though, if I'm getting ready to sell it,
Then then it doesn't matter if the value goes up for your property tax. You're getting rid of it.
yeah, and I want to have a professional opinion of what this property is actually worth. Yeah, if it's not necessary,
Yeah.
don't do it. Just use your bills. Just use the bills. That's all you need.
Use what the county sends you. Let them do that work for you.
Oh, and the county sends their records because when they file for permits and stuff, right?
Right.
Right.
They're gonna know that there was an adjustment made to the property.
Right.
And-
So your appraisal and your assessment will go up.
And your insurance, but that's a different
Right. But that's the county assessing it. Okay. That's not bringing somebody in from a professional firm to come in and give you a professional appraisal of exactly what your house with this stuff in it in this neighborhood would sell for, because that's how they're going to appraise it. That's how they're going to base their appraisal.
Your car insurance is based off what neighborhood you live
Oh, really?
in. Yeah.
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 And whether you park inside or out.
Oh, that's crazy.
Yeah.
On the street or on the
And
driveway.
what kind it is.
How do they know?
You tell them.
You told them where you live.
You tell them where you live. You tell them whether or not you have a garage. I mean, they're gonna. I mean, most people lump their insurances together. So if you own a home, and your homeowner's insurance is through XYZ company, well, XYZ company will give you a break if you insure your vehicles with them as well. So they already know. Well, she's got a three-car garage. She's got 2 vehicles. Those vehicles are in the garage. I don't have to worry about sun damage to paint. I don't have to worry about weather damage or anything else because she's parking them in the garage.
Right.
So I
The
can.
fact is, I got it so full of crap that I couldn't get a motorcycle in there, and everything parks on the
They
driveway.
just
I'm not
don't.
telling them
Is
that.
irrelevant.
They don't know that.
Right. They don't know that.
But they
you
don't
get
know
a-
that. I'm not telling them.
You get a cheaper rate on your auto insurance than I do because I live in an apartment and I park on the street.
I did not know that the kind of vehicle I have was high known to be stolen easy.
Oh yeah, they charge
And
extra
I
for those.
pay extra insurance for that.
Is it
And
a
Oh,
it's
yeah.
hard to find insurance.
Oh, yeah.
Is it a Kia?
You
Yep.
bet.
Toyota Camrys back in 1990,
Hondas.
You couldn't really
Hondas?
get them insured.
you couldn't
Yeah,
hardly get them
sure.
insured.
I have a little Honda.
I pay a lot of insurance for
Did
my
you not
vehicle.
hear about the Kia that was stolen like a couple years ago that drove into that mobile home out east? That was my sister's house. She was
Oh, wow.
asleep when they did that, and it was stolen
Yeah,
because they had a ring of people stealing Kias.
oh, is that when they had the little chip thing or something?
Yep.
Mhm. Yeah, that
Well,
was my
the
sister's
the
house.
airbag in it.
Oh, wow.
Yep.
If
Yep.
the airbag is gone, that car's gone.
Yep.
That's,
You
that's,
can't afford to get a new bag to put in it.
that's why I buy a Ford. Nobody wants a Ford.
I didn't know about the Kias till after I bought it.
Yes.
Fix or repair daily.
Exactly.
Not all of them.
For only real drivers.
Forged out of rusted Dodges.
Well, I got one
First on
outside.
race day.
I got one
Found
outside.
on
Failed
the
on
road,
race
Found
day.
on road dead.
I lost to a Dodge Ram one time.
No, my favorite story was the guy in the Dodge Duster. All of a sudden, you hear the car go, "Roar!" and he's still falling behind us. And we didn't even hit the accelerator harder. We're just going on our normal acceleration.
Yeah.
Anyway, so examples of repairs and improvements. We've seen this chart before. We saw it last week. Last chapter. All of these are examples of improvements. I can't expense them. I have to depreciate them.
Mm-hmm. Or capitalize them if they substantially increase the
Right.
value of the house.
Exactly. But there's some things up there I don't necessarily agree with. Or I could have a little bit of leeway. Ductwork is an open interpretation. If I'm adding ducting, if I'm replacing ducting, yeah, that's ductwork. I should capitalize it and depreciate it. If I hire the guys to come out and run the air hoses through it and the motorized brooms to clean out the ductwork, that's a repair.
Maintenance.
Yeah, that's maintenance.
If while they're up there they find holes in several sections of ductwork and they replace it,
that's
a
still
repair.
It's still a
Yeah.
now if I go into a house that was built in 1910 and it has absolutely no ductwork in it,
And
And
I
I
have
have-
some installed.
and I have someone come in and put in central heat and air, ductwork to run everything and whatnot, that, if you're going to rent it out, has to be depreciated or at least added to the basis of the house. It can be,
It can be.
you know. If you buy the house and it doesn't have any of that, and you're going to use it as a rental, and you spend $30,000 putting all of that in, you can either depreciate that on its own, or you can add that $30,000 to the basis of the house and depreciate the whole thing as a whole.
There's some interpretation of that one. All right, so Roland back here, he's decided that he was going to paint the interior of the house he's renting. That's just a repair. That's maintenance.
Mm-hmm.
I expense the whole thing right now.
Yep.
Yeah, it puts on an addition. This is an improvement. I have to depreciate it. And I can't take any special depreciate it because I have to depreciate this, since we're talking about a house, I have to depreciate it over the next 29 years. 27 and a half. 39, 27 and a half.
Yep.
I merge the two together all the time.
Thankfully, the Schedule E separates the floors.
Well, and thankfully I know what I'm doing. It's just that, you know. Other expenses I can deduct from rental income include advertising.
Yep.
Auto and travel.
Yep.
Because as a landlord, part of my responsibility is checking up on the properties or stopping by and saying, "Rent. Time to pay the rent."
If Shannon decided to go out west and check on her oil wells, the mileage from her house to the wells and back is an expense for her.
And it doesn't necessarily have to be, like we said, if it's the primary purpose of the travel was to collect income or to manage or maintain or just inspect, because that's part of manage.
Right.
And so I had a guy, he had a commercial building in Independence that he was renting out. He lived here in Wichita, and so once a month, to keep up on his flying hours, he decided that to go check on his property, he'll fly to Independence. He'll rent a Cessna.
I thought he had one.
Did he?
I thought he had one, and that was
He-
how he kept
No,
up
you're
his
right,
hours
he
for
did.
his license.
I thought he had one.
Yeah, he did. He had the Cessna, so he gassed it up, flew to Independence, rented a car, drove down to the property, took a look around, collected his rent, went back to the airport, returned the car, flew back to Wichita. I can expense all of it. No matter how he got there. I mean, if I had a rental property in Hawaii and I wanted to go inspect it, I can't drive there.
Nope. But you can expense the cost of the round trip ticket.
Yep. And I can fly first class because there's no cap.
You don't think the IRS would classify that as an extravagance? Especially when you could have had business class. I mean, it's not exactly first class, but it's better than coach.
Okay, but what do you want? I mean, yes, I know. I mean, but I'm having fun. I'm also having fun, but I realize that although I would never do this, you can fly Southwest to Honolulu.
Well, that's true too.
So do I have to figure that one in?
Yeah.
I would not want to fly Southwest to Honolulu. Thank you very much.
I don't want to fly Southwest from here to Vegas, and that's only $60.
I just can never consider a 737 ETOP certified, but apparently they are. So round trip, by the way. So like I said, his expenses flying to Independence, his expenses flying back from Independence. And that's the only reason why he went to Independence, because obviously, what else is there to do in Independence?
Right, you love it.
Not much.
I gotta go.
My piggish neighbor next door just walked up, took my trash can, and pulled it to his house.
You gotta go.
I may be in jail tomorrow, so just a heads up.
Let us know if we need to bail you out.
All
Have,
right.
have Kelly text us if you're in the can. Also note that local travel between your home and rental property is considered a commuting expense unless your home is used as your principal place of business. Well, yeah, most landlords are going to be using their home as a principal place of business. They're not renting an office building someplace else. Why incur that expense? They're running their business out of their house. And it doesn't have to have an exclusive use room to qualify. Although they probably do.
They probably have a spare bedroom that they've converted into an office for this purpose.
Or they're down in the basement because
Yeah.
there was available room down there.
Yeah.
Overnight travel away from home, 50% of meal expenses can be deducted. I can deduct my hotel as long as it's not extravagant. I will suggest that you stay within the $50 per night range. Even though it doesn't specifically state it at this point, we know that that rule exists in other places. I would follow it.
My car dealer routinely goes to Dallas and Denver for auto auctions. He flies. I usually give him 100% of his tickets because typically he purchases his tickets one way at a time, one way out, one way back. So they're usually right around $60 to $80 for a ticket. So I usually give him that. Now, the 50% of meals that can be expensed, I don't ever give him his meals. Because when he's in Dallas, when he's in Denver, and he goes out for a meal, it usually runs him somewhere between $150 and $200 because he
For what?
goes to a nice place. He gets the steak that he wants. He has the drinks that he wants, and
It's
there's
extravagant.
there's no way the IRS would allow me to give him $75 for a plane ticket twice, one out, one back, $110, $120 for a night at the
Ruth Chris Steakhouse.
well, no, $120 at La Quinta,
Oh, yeah.
and then turn around and let him claim a $200 bill for his dinner. So I give him his hotel because he usually keeps his hotel real. I mean, honestly, never more than about $120 for his hotel room and his airfare. That's all he usually gets, unless he rents a car. which he doesn't do a whole lot. He's more of the Uber type. So I have his credit card statements, and he gets all of his Uber expenses.
Yes. So, 50% of meal is expenses, but I'm with Matt. Nothing outrageous. I don't want you going to Ruth's Chris Steakhouse. I want you going to IHOP,
Yeah.
Applebee's.
You spend 30 or 40 bucks at Applebee's, IHOP, we can give you 15, 20 bucks of that.
Yeah. And if you have to take somebody with you, it's like, okay, I got to drive to Denver. I really don't want to go by myself. It's not safe. I should take somebody with me. I'm allowed to do that too.
Yep. And if you have to pay for his room and
You bought
whatnot,
his meal.
whatnot, that's fine. And you could almost, if you had to take somebody with you, you could almost get away with claiming the meal as more of a business meal.
You could, but since we're on Schedule E and we're really not having a lot of business activity, we're going to leave it. And we'll talk about Schedule E business next Monday. Because tomorrow, the next class is Schedules 1, 2, and 3. As with any deduction, written records must be kept. You must properly allocate expenses between rental and non-rental activities. Standard meal rate may be used for rental expenses as well. Use actual, or you can just use the standard. On Matt's guy, I would consider using just the standard meal rate. Well, he went out to eat, he's allowed to.
Yeah.
The fact that he went to the high-class place is not relevant when I'm using the standard meal rate.
I can get some of that meal deducted, or?
How much? The question you really have to ask yourself is that if I had to go to the IRS, do I really want to try and start arguing any of this? The answer to your question is yes. But is that the hill I want to die on? Is it worth it?
And I already, when I was dealing with my car dealer, I already let him know up front, because he asked. He says, well, can't I take a deduction for my meals while I'm traveling on business? I'm like, well, technically, yes, but it can't be anything extravagant. So you would have to limit where you would go to eat. If you don't want to have that limitation, then my suggestion is you eat the cost of your meal because you've got to eat anyway, and we expense everything else. And he was fine with that.
Yeah.
That way, he doesn't have to worry when he hits Denver, when he hits Dallas, I can only go here, 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 here. What do I feel like? When he hits these places, I want to go here. He goes there, and he doesn't worry about expensing it.
I mean, just keep it on a local level. Do you want to go to Applebee's or you want to go Scotch and Sirloin?
Yeah. Exactly. But that $200 meal, the IRS is going to look at you and go, no.
No, you can't justify that. To
Not when you could have went and had steak tips for $19.99 at IHOP.
Yeah. They're not going to allow that to you. And they're also don't want to know what you had because the days of the 3 martini lunch are also gone bye-bye.
Yes, you can't include alcohol. That's why I'm saying when he goes to these places, he gets the steak he wants. He has the drinks that he wants. Trying to get the IRS to agree to allow you to expense a $15 bourbon and water times 3 is not going to happen. They're not going to let that go. A $100 steak. He gets a 30-ounce tomahawk rib eye with all of the trimmings. It's $140 for the meal.
And politicians also have people at the IRS that they can make things go away.
Politicians have expense accounts that they use for that crap that are paid by us, by the way.
Now, like we said, there is a meal allowance. If Matt wanted to, he could say, okay, I'm not going to give you your actual receipt. However, I'm allowed to give you $50.
Yep.
Actually, it'd be $25 because the meal allowance $50, but if you only take 50%, $25.
So on your $200 meals, I can expense $25 of it.
He could do that. Matt could do that. And the IRS actually wouldn't question that because I took the meal allowance. I'm
Yep.
allowed to. And there's no questions beyond that. All I basically have to do, and I don't have to do that, is kind of prove that he had a meal, and I really don't have to prove that. Generally, a personal car, pickup truck, light van was used for rental activities. You can use the actual expenses or standard mileage rate, just like on the Schedule C that we discussed earlier. And if our car is mixed use, then I have to allocate expenses between personal and business.
Mm-hmm.
But when it comes to our landlords, a lot of the times they have a truck. That is basically, that's what it's for.
Yep.
The truck is for my properties. I drive it down there to go get the rent. I drive it down to Home Depot to get my supplies. The only time I'm driving that truck is when I'm doing rental activity stuff.
And when you're doing expenses for vehicles, there's one question that needs to be answered, and it'll basically give you the basis for everything. And then there's two questions. They'll ask, is this vehicle available for use after business hours? Well, technically, yes. The next question is, do you have a second vehicle that you can use after business hours? If they say, no, this is my only vehicle, then you know you've got to split it.
Yeah.
But if they say, yeah, I've got, my car that I drive around, for personal stuff, and whatnot, then it's easier to argue that this vehicle, even though it's available after business hours, is 100% business. That's what he uses when he conducts business.
So Clay is not very wise because he went out and bought a Ford Focus for 16 grand. Drove the car to the building to make repairs and carry out other rental activities. I don't know how he fit that water heater in that Ford Focus, but hey. His written records show he's 23,000 miles driven, 8,000 were for actual rental activities. So his deduction is 8,000 miles times the standard mileage rate at that year, 67 cents. So his mileage expense is $5,360.
Yep. Because he only gets the mileage used for the rental or business purposes.
Ford Focus?
He doesn't have to put the water heater in the Ford Focus. He can go to Home Depot, buy the water heater, and have Home Depot deliver it to the apartment.
Okay.
That's
It's some cost,
it's just
but
expense.
it's an expense to write off.
Cleaning and maintenance. This includes the cost of supplies, materials, and labor, as long as it's not yours, for maintaining the property or preparing it for rent. I can hire Stanley Steamer to come in and steam all the carpets and write it off as an expense.
I can hire Mary Maids to come in and clean the way I want it cleaned because you don't clean the way I want it cleaned.
Well, yeah, that's something I can do. I could go out and rent a rug doctor and clean the carpet myself. I can't charge for my time of doing the labor, but I can certainly deduct the cost of the rental of the rug doctor. Maybe I pay my son to do it. I could do that.
And expense it.
And expense it. I could do that.
Rent a rug doctor, pay you $100 to clean the carpets. I can expense the whole thing.
Commissions. If you pay someone to find tenants or collect rents, these payments are deductible. You'll probably get a 1099 NEC because they're the ones that's basically doing all the work. Exactly.
Mm-hmm.
So so when he takes his cut, that's an expense. He takes 20%. Okay, fine. I can deduct 20% of my income as an expense for commissions. Management fees. You pay someone to manage your rental property. These payments are deductible. This can include collecting rent, making repairs. Again, we've kind of talked about this before, so let's just kind of keep on going. Insurance. Obviously, I have a house or a building. I'm going to insure it. Otherwise, I'm stupid. If my premium is paid for more than 1 year in advance, deduct only each part of the premium that will apply for the period that the year is deducting. So if I pay twice a year and it happens to go over January 30 or January 1st, I can only deduct my expenses up to December 31st, and I got to carry the rest over the next year. Nobody's doing that. Even worse if I was paying it a year in advance and my premium was due in May. They're just looking at it like, okay, well, I had last year's, so this year's, they're not breaking it out that much, and it's not really that significant, for the most part. This is what you're supposed to do. And if it's big significance, yes, do that. Legal and other professional fees, like attorney fees for preparing lease, collecting rents, evicting tenants, yes, we already talked about that. My fee for figuring out your Schedule E goes on this.
Yes.
Mortgage interest, I can deduct the interest that I'm paying on the property.
Property tax.
Property tax, we're not down to taxes and licenses yet.
Oh, okay. I was just thinking that's also on schedule or on a 1098 for mortgage.
So a lot of my landlords have a 1098. Because the mortgage company doesn't necessarily care that it's a rental property.
No. As
They're
long
going
as
to
you're
just
making
issue
your
the 1098.
as long as you're making your mortgage payment.
Taxes, property tax you based on the value of your rental or personal property are deductible. Local benefits that increase the value of your property, such as charges for putting in streets, sidewalks, sewer systems, cannot be deducted. These charges are not depreciable. They do increase the basis. We talked about this last time too. City decides that dirt road out front, they don't want it out there anymore. They're going to put pavement, which increase the value of my house. I have to increase the basis in my house. I don't get to expense the increased tax, which sucks.
Well,
Short term. Supplies, utilities, generally deductible if ordinary and necessary for conducting the activity. Utilities are self-explanatory, but they could be the utilities for the electricity at the rental house, or it could be a portion of my internet at my house. Remember when we talked about business use of home? Those same rules apply here.
you have 15 properties that you're managing across Wichita. You have your office at home. You have QuickBooks on there to keep track of everything. Well, a portion of the internet that you use so that you can access QuickBooks. You get to take a portion of that monthly bill as an expense. The purchase of the QuickBooks or the
Whatever
membership
accounting
fee,
software,
the membership fee for the QuickBooks, you get to take that as an expense. I mean, you could do a portion of the utilities, and then you can break it all down. There's a simplified method that
Yeah.
you can use for this as well, for business use of the home. But and it's the same, but
So just follow those rules, should be fine.
Yep.
Depreciation, I am not going to beat that dead horse. We talked about it last time.
no.
But it's an expense. Oh, God, I'm really not talking about that.
Depreciation on a rental property, take. Depreciation on your home,
Your business-
never.
Yeah, your home business, don't do that.
Even though technically you could, never.
So do remember that we have different categories. So when we're talking about the house, we're talking about the business property that we're renting. Those are 29 or 27, 39 and a half year properties. But some of the things that I can do on the inside are their own class. So if I bought a computer for use in the business, it's a 5-year property, not 37 or 29. And I got those backwards again. I'm good at that.
You know it's one or the other.
Yeah. Appliances, though, that comes into a lot. Stoves, refrigerators, washing machines, dryers, all of that fits under this 7-year or the 5-year property.
Yep.
Garbage disposals, trash compactors. If they have to replace it, you have to depreciate it. Although I could take bonus,
Yeah.
and I probably would. Unless I'm talking to the guy, or I'm always talking to my clients. part of the thing is that we're doing an interview. We're talking to our client every year. I want to know what his thoughts are. If he's thinking about selling his property in the next couple of years, I'm not taking bonus.
No. But if he's going to keep that property for the next 10 years, I'm not worried about whether or not that garbage disposal is going to last 5 years.
Yeah.
Because he's never going to tell me in 3 years I had to replace the garbage disposal again. We just let it run until it's out,
Right.
and that's that. But and Shane does the same thing. When I have a client like this, I always ask them, okay, look, you replace this, you replace this, you replace this. We can run this one of two ways. We can claim it as a repair and expense it now. We can, or if we have to depreciate this. Now, there's two ways we can depreciate it. I can do it over a set period of time, or this is eligible for bonus depreciation and maybe 179 depreciation, and we can depreciate the whole thing this year. So it'd be almost the same as being able to expense it. Catch. If it doesn't last for the depreciable life, we may have to pay some back.
Chances of that happening? Not very high.
Yeah, chances not very high, especially if it's on something like a 5-year or 7-year property. I mean,
Yeah.
think about any home you've ever rented. When was the last time you walked into an apartment built 50 years ago that didn't have a 20-year-old dishwasher in it? That was still working. You know what I mean? So, I mean, he puts a brand new dishwasher in for $1,000. I can depreciate the whole thing out right now. He doesn't have to wait 5 years for it,
Right.
and it's going to be there in 15 years when he sells the property. Because he's not going to replace it; he's going to repair it as much as he can. Because the repairs are expensive.
Yeah. And for the most part, he'd rather expense out the dishwasher. That's what he's really doing. When he gives you that receipt, he's expecting you to expense it.
Yeah.
Well, I can't. But I can do you almost as good. But like I said, I need to know what your plans are.
Yeah. If
I got to know what your plans are.
you're replacing the dishwasher and you're thinking about getting out of this in a year or two, then we're not going to give you the bonus. We're just going to depreciate it for the life for the depreciable life. That way, when you sell it in a year, there's nothing to claw back.
Right.
Because you've only taken 1 year of depreciation. You don't owe anything back.
Right. Now, if I run into the example that Suzanne brought up earlier, where you got the 90-some-odd-year-old guy still running his rental properties, because that's what keeps him going, I'm not worried about him selling it.
Mr. William, yeah.
I'm not worried about it. I'm taking the special because that's just going to roll over to whoever inherits it, and they don't have to worry about recapturing that.
How many kids? 13 kids? How many adult kids does he have?
What, my 94-year-old landlord?
Yeah. 'Cause I know
One.
the granddaughter's the one that brings.
The granddaughter's the one that brings him in, and that's the only one he's got.
Oh,
She's it.
I thought he had a brother.
So she's going to get it all. But I'm taking special for him.
Yeah.
Because he's not going to sell it because he's gone this far. So he ain't selling it. The only reason why the property's changing hands because he died and she inherited it. I don't have to worry about it because she's going to get a new basis.
Yeah, because he doesn't actually, not actually receive rent.
Yeah. I mean,
He's
We don't
a
have to go
giver.
complicated.
Right,
for
he's,
some-
he's a giving type.
for some properties he does, for some properties he doesn't. Because of his age, he gets taken advantage of a lot. So he'll rent to people. They'll stay in there 3, 4, 5 months, not pay for anything, and then up and leave, trash the place. So he'll go in, fix it. He pays all of the utilities. I mean, I've got utilities for every single property of his.
That's crazy, man.
So I mean, he's probably sitting right now on about $30,000 of rollover expenses, rental loss that he's probably never going to get through.
And she's never going to get it.
And she's never going to get. The nice thing about it is his losses are high enough that even with the rollover, he keeps adding to it every year. So almost 100% of all of his rental income coming in,
It's expensed out.
which includes his farmland in Colorado,
Ah,
is zero because he gets $9,000 a year for not farming the land in
Right.
Colorado. It's a rent, so it's passive, so it qualifies as to be taken off of his rental losses. But his rollovers are so high; he has so many expenses that he'll never deplete them, but he never ends up owing.
but once he dies, it all goes away.
Yeah, once he dies, it all goes away. But once he dies, granddaughter's already told me the
She's
second he's planted and cold in the ground, the properties are gone.
Yeah.
And I don't blame her. I wouldn't want to mess with it either.
Yeah.
All right, so like I said, you can see, I was skipping through a lot of depreciation because I don't want to re-bog down for you. Got a whole chapter that we talked about last time.
Yeah.
I will remind you it's about special depreciation allowances because we have been talking about it. The special depreciation is capped if for 2025 if you bought it before Trump took office. So if you bought it under the Biden administration, he said, screw you, you get 60% bonus. If you bought it under his administration, he says, thank you, and gives you 100% bonus.
So if you bought it after February 1st,
January 20th.
well, January 20th, but just to be safe, February 1st, if you bought anything, you can take 100% bonus depreciation on it. And technically, if you bought it under the Biden administration, it's already on a depreciation schedule. We're not worried about it. So
Except if you bought it this January, and then mid-month. I mean, yeah, there's
Yeah.
really no way of keeping track of that, but the rule is written.
yeah. Yeah.
So, and if I'm taking special depreciation, I'm not worried about 179. Because special is taking it all. And it's all or none per class. But I can't do it on 29 or 27. I can't do it on 37, 39 and a half year properties.
20 years or less.
Yeah, 20 years or less. I can take special. Or I can take 179, but there's no point in doing both.
No.
Technically, I could,
I mean,
but I don't have to.
if you bought your depreciable item January 10th and you only qualified for 60% bonus depreciation, you could turn around and take the 179
For the rest.
for the rest.
But you got to do that first.
And technically, if you're eligible for both, your 179 is going to take 100% anyway. You'll never see your bonus depreciation.
Right. So there's all sorts of ways that you can get around it.
Because when it talks about when you start talking about bonus, the depreciation stuff, 179 depreciation bonuses come out first.
Yep.
Then if there's anything left, it goes to bonus depreciation. Then if there's anything left, it goes to regular depreciation.
Right. But with the way the bonus herd is now, there's nothing left.
There's nothing left for depreciation.
Limits based on property use. The use of the property determines the amount of expenses that can be deducted. There are special rules if the property is not rented for profit, if the property use is changed from personal to rental use, if only part of the property is rented, or if you have a personal use of a vacation home or other dwelling unit that you rent out.
I hate these.
I hate talking about it because at the end of the day it's fairly simple, except for some of the trigger rules. But otherwise, a lot of it just makes logical sense. When you rent a property for less than the fair rental value, which would yield a net loss, you don't have a profit motive. So my expenses are also going to be limited, basically to whatever income I have. No more, no less. Properties on rental for property, these rental expenses do not exceed the rental income can be deducted. Don't use Schedule E. Any rental expenses that are more than the rental income cannot be carried forward. So I get to zero and I stay there. Whatever I can't use, I don't use. Not-for-profit rental income is reported as other income on Schedule 1, line 8J. Deductible expenses related to the income are reported on 8. I'll see if that's L.
Mm-hmm.
Since we're using lowercase letters. So Buddy and Dolores rent their upstairs flat. We're British.
I guess.
$100 per month to their cousin, which is less than the fair market value of the property. They're not considered to be renting for profit. They report $1,200 on Schedule 1. Any expenses up to $1,200 will be deducted on Schedule 1, 24Z. Although it said L earlier, so take a
Well,
look.
it said 8L and then 24 something on the
Yeah.
previous slide, but basically what they're saying is if you rent it for less than fair market value, you can only claim in expenses up to the total amount of rent you receive, period.
Which is basically what they're trying to do. Especially here, I'm renting in my cousin. I'm giving my family discount rate. You know, I should be able to rent this flat for $800 a month. But since I'm only doing it for $100, no profit motive, and to stop people from renting it for cheap just to run up expenses, to write off other aspects of their income, which is obviously what happened one time where this rule wouldn't exist.
Yeah.
Remember when we talk about rules is that they exist because somebody tried it.
Somebody tried it. The IRS questioned it. They went in and said, well, this is what I did. Why can't I do that? And the IRS said, oh, hell no. And they made a law.
Yeah, they went back and changed the rule. He got by with it the first time.
Yeah.
They went and plugged the dike. If you change all or part of your home or other property to rental use after the beginning of the year, the yearly expenses such as depreciation, taxes, and insurance must be allocated between rental use and personal use. I was living in my home until June when I decided that I'm going to move into this new place, but instead of selling my old home, I'm going to rent it out.
Yep.
And I start renting it out after June, or make it available to rent June 1st. Well, I have personal expenses, so obviously I'm not going to be able to write off all my expenses related to the house as a rental expense. I can write off everything as a rental expense that I racked up after June 1st. But up until then, I can't. It's personal. I live there. So that makes sense. My basis for depreciation is the lesser the adjusted cost basis or the fair market value of the property. Can be. Deduct on rental expenses only the part of the expense that was for the part of the year the property was held or used for rental purposes. Which is logical.
Mm-hmm.
So the stuff that I might be so going back to my example, I could write off on Schedule A my interest I paid on the house for mortgage on Schedule A up until June. After June, I can write it off on Schedule E. Which might help me a lot because I might not be able to file Schedule A, but I certainly can file Schedule E.
Yep. Property tax the same way.
Property tax the same way. Whatever I paid before June 1st or January 1st, June 1st, goes on Schedule A. After June 1st, goes on Schedule E.
Yep.
House insurance. Well, I can't put that on Schedule A, but I can certainly put it on Schedule E after June 1st. And so on and so forth. Kate moved from their personal residence on June 30th, started renting on July 1st. For 6 months it was rented. They could deduct on Schedule E the rental expenses such as mortgage, interest, taxes, insurance. Depreciation starts in month 7, using the lower of the fair market value or adjusted cost basis. That's where you hire your appraiser.
Mm-hmm.
On Schedule A, they can claim the other 6 months of the yearly expenses for mortgage, interest, and real estate taxes, but not the insurance or depreciation. because that's personal. And there's no place to put it. If part of the property is rented and a separate property is for personal purposes, then the expenses must be divided accordingly by establishing the business use and personal use percentage. Obviously, the total is equal in 100%. So you're kind of treating it like two pieces of property. I have one example of this. It's actually my complicator, British Columbia clients. They rent out their basement. 50-50. So housing expenses are divided. 50% is personal, that's for the upstairs. 50% is business, that's for the downstairs. Actually, I Schedule C this because she's a real estate professional. She works for Remax.
Oh, well, sure.
And then I exempt the self-employment tax because she already paid it to Canada. And all of that's within the rules.
Mm-hmm.
But there's that example. That's exactly what I'm talking about. And it doesn't require, although they do, but it doesn't require that they have separate access. Whether they go to the front door to make it to the basement, or whether there's actually a walk-in basement. That's not a requisite.
Just two separate domiciles.
Right.
If the downstairs has a place to sleep, a place to eat, and a place to go to the bathroom,
It's a domicile.
it's a domicile.
And that threshold is met.
Hmm?
And the place to eat is not exactly the hardest thing in the world to do, because basically all you're asking is there a sink?
Yeah.
Because after that, I could use an air fryer and a toaster oven and a toaster
Hot
and a
plate.
crock pot and a hot plate. I have a kitchen.
Electric skillet, electric griddle. You don't need a stove or
Yeah.
a range or any of that.
Microwave, all that is, there's nothing special about it.
No, you just have to be able to prepare and eat a meal.
Yeah.
You can do that with a microwave and a hot plate. You're good.
You've met the requirement.
Yeah. You don't even have to have a bedroom. If you've got a couch and you sleep on the couch, you're good.
It could be a loft type setting
Yeah.
in the basement. I mean, the rule is that can you do these things? It doesn't say it has to have separate rooms.
Yeah. You don't have to finish the basement so long as there's a toilet and a shower, someplace where you can make a meal and someplace where you can sleep.
You met it.
You've met it. You don't have to finish that basement. You don't have to have individual walls, individual rooms, carpeted floors, or anything. It can be concrete all around, exposed rafters and
Yep.
pipe, plumbing, and everything else. As long as you've got a place to do all that, you're good.
So for expenses that apply to the entire property, only subtract out the business part. Whatever ratio that you've arrived at. 50-50, 60-40, 90-10, I don't care. It might be 90-10, you might just be renting out the room. Which doesn't, I still don't have to worry about as long as they have access to the house bathroom and the house kitchen. I've met the requirement.
Yep.
Hell, they might be paying me to make the meal. Which actually would become Schedule C income to me. Because I'm providing a service.
Yep.
So I'm renting out the room, that's Schedule E, and then I'm providing a service of doing meals, Schedule C. Which is something we haven't talked about. I've always used the example when I talked about providing that service is that I'm renting out the house to the little old lady, and I'm providing an extra service is that I'll run the Dillons for her to pick up her groceries.
Which 15 years ago was a thing. Now
She
Has
just
it
calls
delivered.
Instacart or gets on her Walmart app and takes care of herself.
yeah.
Reminds me I could order some food. Well, tomorrow's meeting has really thrown me off as far as my meal planning. I'm in scramble mode on that one.
Yeah.
So we've already covered this. So, in another example of what we're talking about, May, she rents a room in her house to a tenant. Room is 180 square feet. House is 1,800 square feet. So she's already at 10%. 10% of the phone bill, 10% of the gas bill, 10% of the electric bill, 10% of the water bill. She can expense on Schedule E.
10% of her mortgage, 10% of her property tax.
All of that. The rest is personal expense, can't be deducted unless it qualifies on Schedule A. If May paints the room she's renting out or puts in a second phone line to that room, that's 100%.
Mm-hmm.
But there's a separate internet access point under its own account. 100% on that one, if she's paying for it. If you have a personal use of a vacation home or other dwelling you rent out, the expenses must be divided between personal use and rental use. If you have enough personal use that is considered a home, then not only do you have to divide the expenses, but the deductions you can take are limited. This is where it gets a little confusing. Vacation home or dwelling unit is considered a home during the tax year if it is used for personal purposes more than the greater of 14 days or 10% of the total days that is rented to others at a fair rental price.
Please do not confuse total days it is rented with total days it was available for rent.
Because those are two different things and one doesn't work.
Yes.
Active rent. How many days out of the year was it actively rented? Is the 10% that you're shooting for on this one.
If you stay at your vacation place in Florida for 14 days and then turn around and rent it out for 100 days, guess what?
You didn't make it.
You didn't make it. Even though it might have been available for rent for the entire time except for the 14 days that you were down there, it was only rented for 100. You don't get anything.
So, and it could get complicated in a hurry because let's take Bob's Colorado cabin.
Yeah.
It's already closed.
Yeah.
He can't rent it out between basically Labor Day and Memorial Day because you can't get there. They don't plow the road. So he's got it buttoned up tight.
So June, July, and August is all he gets. 3 months.
And he's there for a part of that time. But 10% of the total days it was rented to others at a fair price. He's got a big hill to climb because basically he could almost not go there.
Well, yeah.
Because he's only got 3 months.
He's got 3 months. If he hasn't rented out the whole time, that's 90 days. That means if he uses it more than 9 days out of the 90 days he had it rented, he doesn't get anything.
Right. He can't write it off. If a dwelling unit is used for personal purposes on the day it was rented at a fair price, then count that day as a day of personal use when determining the dwelling unit was used as a home during the tax year, and a day of rental use when dividing the expenses. Doesn't matter what time I left, the fact is I woke up there as a personal use day. When I'm counting how many days I was there, it counts against my 10. Counts against my 14. Well, and my 10.
Yeah, 10%.
But on the expenses, if I leave at noon and he shows up at 5, that's my expenses for the entire day are actually rental expenses. A day of personal use of the dwelling is any day that is used by you or any other person who has an interest in it. Whether it be your wife, your son, obviously they have interests in it. got really confusing when we think about Susan and all the people in her family for their Colorado cabin. That list was huge. Basically, they were never able to rent it out. Although, you could talk to them. It was available if you can fit it into their schedule. A member of your family or a member of the family and any other person who has an interest in it, unless the family member uses the unit as his or her main home and pays a fair rental price. Well, there's a little loophole. Anyone under arrangement that lets you use some other dwelling unit. So you can't say, I'll let you rent my Colorado cabin if you let me rent your cabin on the beach in Florida.
Yeah.
You get to count that as a personal use day,
For both of you.
even though you weren't there. Anyone that you rent to at less than a fair rental price.
Personal use.
That's going to be counted as a personal use day because I didn't charge the market rate. Do not count as a day of personal use of the dwelling unit any day that you spent there working substantially full-time repairing and maintaining the property. So it's not a personal use day if I'm there fixing the sheetrock, cleaning the pipes, cleaning the carpet, dusting, painting.
Replacing the door the bear kicked in.
Yeah, in the Colorado cabin, that is definitely a possibility. So technically, when Bob spends the day there, buttoning up the cabin, winterizing it, that's not a personal use day.
Nope.
The first day that he shows up to unlock the cabin and get it ready, unwinterizing it, that's also not a personal use day. He could stay there, he could sleep there, he could eat there, that's not a problem. But the reason why he was there was to perform work.
Get it ready for rent.
Saw firewood. Then there have to be stuff inside. He went outside and started cutting firewood. Because you still want it at night. You're definitely at altitude, it's definitely going to get cold.
Yes. Yes. May in the Rockies is not balmy by any means.
If you use a dwelling unit for both rental and personal, divide the expenses between the rental and personal use based on the number of days used for each. When dividing the expenses, follow the rules. Count any day the unit was rental as a day of rental use, even if it was used for personal purposes that day. Count any day the property was available for rent, but not actually rented as a day of personal use. So Bob's already screwed. He can never actually do this because 6 months out of the year he can't rent it. Those are all personal use days.
Yep. So there's no dividing.
He can't write off any of the expense.
Basically, Bob's Colorado property, he gets to write off in expenses up to the amount he makes in rent. That's
Yeah,
it.
that's it.
So the best his rental property in Colorado can do is zero.
How to figure net rental income or loss from a dwelling unit used for both depends on whether the dwelling unit was used as a home, and if used as a home, how many days the property was rented. Property not used as a home, if you do not use the dwelling enough that it qualifies as a home during the year, report all the rental income, deduct all the rental expenses as any rental value of real property. Yeah, there's no way for him to get around that one either.
Mm-mm.
Because the months that it's not available is what really kills him.
Well, I mean, on his Colorado, I mean, if he rents out the cabin for less than 15 days, then he doesn't have to worry about claiming any of that
Right.
as income.
But he can't take any expenses.
But he can't take any expenses either.
And we haven't got to that part yet.
Oh, thought that's the part we were on.
That's actually at the bottom of the slide.
Okay.
If a dwelling unit is used enough that it qualifies as a home during the tax year, how you figure your net rental income or loss depends on how many days it was rented. If fewer than 15 days, do not include any of the rental income and gross income. Do not deduct any expenses. Yes, you are reading that right. You can rent out your house, a room in your home for 15 days or less and not report the income.
I have a house on the beach in Fort Lauderdale. I let all my family and friends go down, use the house, so they've got beachfront property for their vacations. But for 1 week a year, I rent it out to spring breakers. 7 days, 10 days. Rent it out for $1,000 a day. That income, I don't have to claim.
Nope. You can rent it out for $1 million and actually not claim it.
Yep. Doesn't matter how much I rent it out for. As long as I don't rent it out for more than 15 days, I don't have to claim any of it. I don't get any of the expenses, so they might, that 10-day period, they might give me $10,000 to rent the house, but if I have to turn around and spend 9 repairing what they tore up, you know, I'm out
And
that.
replace the carpet again.
Yeah, I'm out that. I don't get to claim any of that. But at the end of the day, whatever's left over, I don't have to claim as income either. So,
Yes, there is one loophole that still remains.
yeah. That's when you become really picky about what spring breakers you let rent your property.
Well, they're in Florida, at the beach,
Yeah. You're already doomed.
they're probably only gonna have fun.
Yeah, well, I'm
Well,
going
see,
to rent it
that-
out to Ivy Leaguers because they're not just, hey.
That's when you rent it out for $1,000 a day with a $5,000 security deposit for any any damages or whatnot to the property, and then after I go in and I check and make sure everything is what, then I give them their $5,000 deposit back, but that at least gives me a little extra to cover my expenses
Or
with.
you could require, rental insurance.
I don't know
Like
if you're going to be
apartments,
able,
like apartments do.
yeah, you could.
And insurance is not deductible, right?
Insurance.
Insurance is.
But in this case, no.
No, in this case, no.
No, because I can't take
Like
any
our
expenses. Because I can't take any expenses. Because at 15 days, I'm really not. I really don't have a profit motive. That's what you're falling under.
Yeah, yeah. But on a typical rental property, whether it's residential or whether it's real business, business property, then yes, the insurance that you pay for that property is a deductible expense.
So if you rent your home for 15 days or more during the year, include all rental income and gross income. If you had a net profit, all the rental expenses may be deducted. If you had a net loss, I can only go up to 0.
And then the rest of your losses carry forward.
So in 2024, Zeke rented his home to the delegates of the Cheese Producers Convention. Received $1,400 in rent. It's the only rent he receives during the year. He does not have to report the $1,400, but he can't deduct any expenses.
Nope.
All expenses for rental part of mortgage, interest, real estate taxes, casualty losses, direct rental expense, such as advertising expenses and rental agents' fees can be deducted. These expenses can be deducted even if they result in a net loss. We're back to assuming that I'm renting for profit.
Mm-hmm.
If any income is left after deducting these expenses, deduct your other expenses up to the remaining rental income. So take your ordinary expenses and deduct them first. And then if you have anything left over, then start doing your indirect expenses, your depreciation.
Mm-hmm.
Up until the point that you run out of money.
Till you hit 0.
These other expenses must be deducted in a prescribed order. First, deduct rental portion of operating expenses like utilities and repairs. Then deduct rental portion of depreciation. Any amounts that you cannot deduct can be carried over to a future year. But keep in mind that next year I have the same limits.
And next year, your carry forward amount will go first.
Yeah.
Then your regular expenses, then your depreciation, which is like my 94-year-old landlord, that's how he keeps rolling forward expenses from year to year because he never earns enough to completely deplete his rollover. So all of his expenses in the current year get added to what's left of his rollover and go to the next year.
Rental real estate activities for which you receive income mainly for the use of tangible property rather than for services provided are considered passive activities. I'm not doing the work, the money is.
Yep.
The amount of passive activity income loss that can be deducted from non-passive income is limited by at-risk rules, as well as by passive activity rules. Well, I might not be limited by at-risk rules because I might be all at risk. It's my house, I'm the landlord, I'm the one that makes all the decisions. I'm at risk. I take all the responsibility. If you use the property enough that it qualified as a home during the year, the passive activity rules do not apply to that property. Instead, you must follow the rules that we talked about earlier under personal use of a rental property used as a home, where I'm really limited, maybe not even doing any.
Mm-hmm.
Losses from passive activities are first subject to at-risk rules. These limit the amount of deductible losses that can be taken on most property. Losses from real property placed in service are not subject, or before 87 are not subject to this. I'm not really worried about that. It's a long time ago.
If you've got rental property that you put into service before 1987, it's 100% depreciated already. There's not much you're doing except collecting rent.
Yeah. That might be your guy.
Yeah, my 94-year-old?
Yeah. Generally, the loss cannot exceed the amount you have at risk at the end of the tax year. The amount at risk includes your cash investment as well as loans for which you're personally liable. The mortgage on the house. So I'm at risk for what I owe on the house and what the house is worth. Even if fully at risk, the loss may be limited by the passive activity limits. Rental activities where there is material participation during the year are not considered passive if for that year you're a real estate professional. You should have known better. You should know how to run a property.
Yes.
To qualify as a real estate professional, the time spent performing services of real property or trades or business in which you materially participate must be more than half the time spent performing personal services in all trades and businesses and more than 750 hours. Well, if you're a real estate agent, that's your income, it doesn't matter. That's your livelihood. You're doing this.
But if you're not, if you're just Joe Schmo with 15 rental properties around here, in order to be considered materially participating in that activity, you have to spend more than 750 hours a year managing your properties. Which, for most of our landlords,
Not a
is
problem.
not a problem because they take care of the rent, they take care of all of the repairs. You know, I mean, even if they're contracting it out, their bookkeeping, all of that stuff all combined together, they well exceed the 750 hours a year.
Yeah, that's not very much.
No. I mean, think about it. If you do 40 hours a week times 52 years, or times 52 weeks, that's over 200 hours, or over 20,000 hours, or 2,000 hours. Pardon me.
Yeah. Short way of saying I don't have to be involved full time.
Right.
Because rental activities are passive activities by definition. Again, I'm letting the money do the work, not me. You generally cannot offset income other than passive income with rental losses. Any excess losses carried over to next year. I need a 4582 to keep track of this. Your 92-year-old guy has a 8582 that goes back a hell of a long time.
Well, it goes back as long as I've been doing it for him.
Shannon must be back.
She is.
Well, plus there was somebody out there walking around.
Is there more police?
No, they didn't chase me down.
Dude, I caught my trash man right as they were picking up my trash. I was like, no, you can't take it. My trash can was packed full. So the cops don't come out for that. I had to call the city. They now want a copy of the video and the picture of the trash in the trash can that I took. And I told him, I said, what are you going to do about all the stuff that's piled up against the house? Well, we already took care. This is the city. He said, we already took care of that. And then you realize he's looking at the wrong address. And I said, no, because this stuff has been there. And he goes, well, can I get in your backyard? I said, you don't need in my backyard. So he's on his way out. But I gotta figure out how to send this video to him. So I need to get him paid. So now I'm gonna see if you can access
Send it to the office.
email. You think it'll still play on email?
Should be able to.
Should be able to, because that's what he's going to do.
If you go to the video and just click share. and
It's
put
not
it-
that hard. If you're using Ring, it's easy.
Yeah.
And I know
I
you're using
downloaded
Ring.
it already and I accessed anybody that got the link to be able to open it.
Yeah.
Okay.
You just need to send the link.
And just share the link to the
Office and see if it
to
goes.
the email.
If you actively participate in a passive real estate activity, you may be able to deduct up to $25,000 of the loss of your non-passive income. So if you're married filing separately, you only get half of that, which makes sense. Not the first time we've been exposed to that rule. If you're married filing separately, lived with your spouse at any time during the year, you don't get any of it, and you'll be glad by enforcement. The maximum special allowance is reduced by 50% for the modified adjusted gross income that goes over $100,000. Because we don't want you to write off too much non-passive expenses.
Keep in mind, when it says modified adjusted gross income, if you're working at Spirit and you make $75,000 and you bring in another $35,000 in rental income, you
Yeah.
now have $110,000 of modified adjusted gross income.
Yep.
Get out of there.
If you're 150 of AGI, you don't get any at all.
Yeah.
Actively participate in real estate activity if you're including your spouse's activity at married filing jointly is at least 10% of the rental property and you made management decisions in a significant and bona fide sense. Whatever that is. Who you're going to hire, who you're going to lease it to, all of that. I had input. Whether or not they took my advice is not relevant.
You argued with your spouse 3 times a week over the idiots he or she keeps renting to. That's material participation.
Yeah.
Believe it or not.
Oh, I believe it. Pat, single, W-2 and 1099 reflected wages of 33. Taxable income, interest income of 5, dividend of 12. That's all non-passive. He also had $3,500 loss from his apartment house that he owns. Pat advertised and rented the unit himself, collected the rents, arranged for repairs, owns it 100%, made all the decisions. He can use the entire $3,500 loss to offset other non-passive activity income. So he can take the $3,500 loss and take it up against all that other income that's up at the top. He can lower his taxable income.
Yes.
Now, put him at wages of $125,000, no other income except rental. His $3,500 loss is going to be limited. If you're married, filing separately, and lived with his wife at any time, he gets to do none of them. But he does get to fill out 8582 to potentially use it next year.
If the circumstances are right.
Right. I said potentially. If you rent apartments, or if you rent buildings, rooms, or apartments and provide only heat and light, tax collection, etc., report the rental income and expenses in Part 1 of Schedule E. However, if significant services are provided primarily for the tenant's convenience, such as regular cleaning, changing linens, maid service, that's a Schedule C activity. Part 1 of Schedule E is used to report income and expenses up to 3 rental properties. If I need more, fill out more Schedule E's. Complete lines 1 and 2, Part 1 for each property. You're describing the property. I like to use address. It's just easier that way. Line 18 is Schedule E, enter depreciation expense. If I need a 4562 because I'm starting something, attach that. Otherwise, I don't need it. Total amounts from rental properties shown on line 23A through 23E.
So there's no excuse now.
Income and losses are total on 24 and 25. So in January, Miss Johnson bought a condo to live in. Instead of selling the house that she'd be living in, she decided to change it to rental. Started on February 1st. $750 a month, collects it herself. Also got a $750 security deposit. Because she plans to return it, she doesn't count that as income. Other expenses, we have mortgage interest, fire insurance, real estate taxes, miscellaneous repairs after renting. But she must divide the real estate taxes and mortgage interest and fire insurance between the personal use of the property and business or rental use. So 11/12 because she converted in February.
Someone tell me, is the place next door closed?
CD
CD
Trade
Trade
Post?
The CD.
Yeah,
Yes,
no, they're open.
it's
They
open.
just
They're open now.
they should be open now.
Okay.
Yeah.
I was gonna say the Leslie's there.
It's after 11.
They don't do lunch, do they?
No, no.
No, they just open at 11.
Oh.
They open late.
Yeah, they don't open till 11.
Besides, I think they do like we do here. They just get something and eat while you.
Yeah,
They
Leslie
don't. They
just
don't.
orders.
Yeah, they don't close the office
Yeah.
to
Yeah.
eat.
She can deduct 11/12 of these expenses as rental. She can include the balance of the allowable taxes and mortgage on Schedule A, so 1/12, which isn't going to be much. 100% of the repairs. Well, you're paying the regular property tax that you normally live, but now you get the expense and against income. She was paying it before, she still continued to pay it. Now the goal is to charge enough in rent that it covers those expenses.
Oh, you didn't say the address this time.
Some joint in Wisconsin.
You did.
She sold it so she could move to the better state in Minnesota.
Stop. It's really weird because that last page says actually the town that I grew up in. And it ain't even a house. Tomo, Wisconsin is where I was born and raised.
And 1,000 Superior Avenue is in the lake.
No, it's not. It's on the main street. But it's a business, not a house.
So let's see here. On February 1st, when she changed the house to rental, fair market value of 152 of this amount, 35,000 was for land, plus 17 was for the house.
It's good.
Because their adjusted basis is less than the fair market value of the change, she's going to use 39,000 for her basis for depreciation. House is residential rental property, was 7.5 years. April 1st, she bought a new dishwasher for the place at $435. Starts a depreciation on it for 5 years. $4,000 to have a furnace installed. This is going to be depreciated. Because she placed the property in service in May, she finds the percentage on makers to be 2.273%. So we have her income, $82.50, her expenses, For depreciation. Well, not looking good for her. This is what her Schedule E looks like. And we're also going to have a 4562 because since she converted the property this year, we have to start depreciation on everything.
Huh?
She converted it this year, so we have to fill out a 4562 to start depreciating the house.
Yeah.
And then she added 2 more things to it to start depreciating.
So we'll just add that to the basis of the house, capitalize it, and just walk away from it.
Yeah, that would be
The easiest.
the easiest had you done it in the original, but one was the dishwasher. That was what? June? No. That was earlier. The furnace was June. But the furnace is going to start on 27 and a half years because they've extended the use of the property by putting in a new furnace.
Well, yeah, but I could just add the.
Yeah,
I mean, we
I would've
haven't
considered
already
it.
we haven't already started the depreciation sheet.
yeah.
So anything like that, I could fold in as a
I could
capitalization
capitalize it, yeah.
because I haven't started it. Now, if she started it and then the next year replaced the furnace, we're talking completely different
Exactly.
situation. Then the furnace has its own depreciation.
But what if you get one of those programs out there that purchases that heating unit and puts it in for you in your primary residency?
And you didn't pay for any of it,
Right.
then you don't get anything. You're
Right.
not out anything.
So do you still list it anywhere?
No,
No, because you didn't change your basis.
you didn't expend any money to. You didn't expend any money to make the upgrade.
Well, you have to qualify for the loan, but then.
And technically, you shouldn't have qualified because it's not your primary residence. It's a rental house.
Yeah, but I'm just.
Yeah, Letitia.
What's her name?
It's Felicia.
Tali. No,
It's Felicia.
no, Letitia.
But-
James. Letitia
Oh.
James.
Hey, stop with the all names.
Yeah. Yeah, he's recording.
Letitia James is the Attorney General for New York.
Oh, okay, never mind. Yeah, that's news.
Yeah. Now, her name's not exactly a well-kept secret.
It's for me. I didn't know what the heck you're talking
I
about.
thought it was a client.
No.
I thought you were talking about Felicia. Or
No.
somebody else out in the line.
All right, so Schedule E is also used to report other types of income, such as royalties, partnerships, S corporations, estates, and trusts. Total income or loss from these sources and rental real estate is all entered on Schedule 1, Line 5. So Schedule E feeds Schedule 1, Line 5, and that's tomorrow's topic. Royalties can generally be described as payments you receive for the use of your property that is based in some way on the number of units sold. Shayna is going to come up here and now talk to you about. Oh, there are 2 types of royalties. Most in. She quit. Oh.
She'll just give you her
No,
settlement
fine.
sheet.
This is what you're dealing with. When you're dealing with royalties, you have a company that owns it, but you get royalties off of it. Okay? So they break it up. They have this much. You get this much. This is the statement. You get a monthly. Oh yeah, I don't get shit.
Well, you used to.
No,
Dylan,
no,
so many of them.
No,
Oh, I thought.
no.
No, she never got
No,
really
I
much.
never really got much.
Because it's not a
So,
big producer.
This is the company. This is mine portion. So out of their
She's not exactly Tommy
$5,000,
Lawrence.
Well,
I got
yeah.
She's not Jed Clement by any stretch.
one. So that's what you're doing.
I'm thinking Tommy Norris from Landman.
Yeah.
And then you get a, oh, that's.
I never watched the
Yeah,
show.
$10.99
That's a
at the
good
end
one.
of the year.
I never watched the show, so I'm
But
stuck
the
with
thing
Beverly
is,
Hillbillies.
though, on
Sorry.
the $10.99,
I watched that show.
Yeah.
no, this is for
No, it's, a,
10.24.
it's a good.
This one's for
Huh?
$9.24.
It's not in one season, it ain't that one. Non-existing
What?
motel.
No, I actually have a
We
natural
saw
gas.
that red pin, that was 1,000 North
I haven't
Superior.
got to check it at
In
all to
Toma.
check for natural gas.
No, it's not.
At all.
Look,
Royalties from the extraction of gas, oil, and minerals from
Right
your
here.
property, just like you
1,000
saw.
North Superior Avenue.
Royalties for the use of trademarks, copyrights, and patents.
And right there is BP.
So my cousin had an uncle who used to work for Goodyear Tire and Rubber, and he had a number of patents that Goodyear was paying him for because he was an engineer.
Oh, this one just says North.
My nephew does
Also,
too, for Big Dog, but he
On the
didn't get it.
royalties thing, just because somebody has royalties does not mean they owe the upper part of the property.
No.
Yeah.
So like we sold our farm, but we kept everything below that. Yes,
He sold the property, but not the mineral rights.
yes. And that goes on a lot more in Oklahoma than here.
So the new owner cannot get those.
Absolutely not. And if they try and drill on that property, it's ours. It's still ours.
So, for an example, a petroleum company wants to drill for oil on land. The company negotiates a royalty agreement with the owner for the mineral rights. The owner of the mineral rights may also own the land or may just own the mineral rights.
So that's from like owning the land, right? So there's
No,
not like-
no,
No?
no. This, right now, no. We used to own it and we would farm it. And we would get green off of it. But we sold it a couple years ago. We sold the farmland, but everything below the topsoil is still ours. So we still get royalties off of that.
If the company strikes oil, the owner of the mineral rights will receive a royalty based on the percentage of barrels pumped out.
Right.
And of course, the price of oil.
And natural gas sucks.
Report the royalties received from oil, gas, or mineral properties, copyrights, patents, Part 1 of Schedule E, Line 4. Enter the royalties in the total column. Enter the gross amount of royalty income, even if state or local taxes were withheld. Because I can expense that. Good taxes withheld. If you have an economic interest in the mineral property, a deduction for depletion may be taken. It's its own special type of depreciation. And it's a percentage-based number against the number of units taken out.
Or the amount of your royalty paid.
Same thing. Any other expenses can be claimed, lines 5 through 21. However, if in business as a self-employed artist, author, photographer, inventor, the royalties relate to self-created copyright, trademark, or patent. Report the payments as part of business income on Schedule C. Steven Spielberg gets paid.
That's Schedule C.
That's Schedule C every time they show Saving Private Ryan. Same for Tom Hanks at that point. Mick Jagger when they sell an album.
Oh, yeah.
Of course, not the best example, he's British. Bruce Springsteen when he sells an album.
There you go.
That's better.
Boston.
So if you hold an operating oil or gas mineral interest in the land, that could go to Schedule C. $10 or more gets a $10.99 miscellaneous with Box 2. Royalties. Partnership is associated with two or more people to carry on a business for profit as co-owners. Sharing the profits and expenses, the partnership does not pay any income tax because it passes through the entity to the partners. They pay the income tax. S corporation does not pay corporate tax. The income is instead taxed between its shareholders based on percentage of stock each shareholder owns. Passes down to the shareholders. They pay based on their percentage of ownership. Losses from an S corporation may be limited by the at-risk and passive limited loss that we've already kind of talked about. So for partnerships and S corporations, let's see here.
This is going to start getting into K1s, I think.
Yeah. So 1065, that generates a K1. You're not making 1065s. I am. Matt is. Takes special software to do it.
Yes.
Pain in the ass.
When can we do 25?
Probably not until after the first of the year because Drake is usually released late.
Okay.
S corporations use Form 1120S. Again, you're not doing that. I am. Matt is. Does he have to use Drake? Or some other special software. And you just can't go. You can't go get QuickBooks and do this. No.
No. You can go get QuickBooks and fill out a profit loss statement that we could use to do this. But there's a whole bunch of other stuff that we've got to do, that we've got to put in order to actually do the 1065 or the 1120S.
Yeah, I'm basically doing the books for a company.
Pretty close, yeah.
When I do it at 1065, 1120S, and 1041. Although 1041 is actually for a trust. But same idea.
Mm-hmm. Estates and trusts.
Estates
Lo and
and
behold.
trust. 1041 is the form that's necessary. Again, you're not doing this. I am. Matt is. All of these generate a special K1. It says up there K1 1065, K1 1120S, K1 1041, K1 945.
And these come in off mostly in our brokerage.
991.
No.
991 too, isn't it?
It's a
Yeah.
substitute form. What's
No.
that substitute form we got for that thing on
Okay, so when you get a K1, whether it is from a trust and estate, an 1120S, a 1065, whatever, when you get a K1, there is a box on there. I think it is box 18 or something like that, 17. It will say, has a K3 been generated?
Yeah.
That box may be checked. Does not mean you have to wait for the K3. It depends on whether or not there is any foreign income or foreign taxes paid on that amount or on that K1, and whether or not the person receiving that K1 is more than a 10% partner. If their partnership level is under 10%, even if they have foreign taxes paid on it, if their partnership is under 10%, you don't have to wait for a K3. The reason you would get one for somebody that might say that there's a K3 generated is because they're part of a larger group and somebody in that group has paid money or received income from a foreign entity. So if you're one of 5,000 people in this group and the top 4 partners in the group received income or paid taxes from a foreign entity, all 5,000 partners are going to get a K1 that says K3's been checked.
Right. So here's our K1. This is what one looks like. This one happens to be, according to upper left corner, a K1 from a Form 1065. Partnerships.
Which is your most common K1 we received in these offices.
Yes. Although the forms are different, the information is very similar. Use the information provided to report on your income tax or losses on your return. Not all items on this form are actually entered anywhere. They might be informational. So, they look scary. They're kind of not.
Okay.
Yeah, you just follow along on the computer. You might have to click different tabs because you can't put all the lines on one tab, so it's broken down after line 9. I gotta click another tab, and that takes me up to line 18, which I gotta click the 3rd tab. And then there's some drop down boxes, and then you'll get frustrated because I went all the way to line 18 looking for box Z and found out that it doesn't exist. It's information only. Oh well. So if you're a landowner, you did not materially participate in the operation or management of a farm, 4835 to report any income on that. We're not really concerned about that. That doesn't really fall into us. Do not use the 4835 if you're the tenant landowner. And so that's that. So, since we have a little bit of time, I have some questions for you that we'll go over real quick. I'll give you 10 minutes to fill this out for funsies. And then we'll go over the answers.
So you wanna see, Shane? This is how stupid this dude is.
Let's go to find out.
Answer it.
I do the same thing. Answer it. If you'll update your Google
And
business,
this is what he did. And I talked to the trashman, and the trash guys were like, he could have put those next to his trash can on the ground. We would have picked them up.
did
Yeah,
that?
but they would charge them extra.
No,
No,
No.
no.
I
Oh.
could put 10 by my, I could put 10 black trash.
When
bags
Shannon
by
showed
mine.
me that, that was my first question. I said, "Do they not?" I said, "If you put it next to it on the ground, are they not going to pick it up?" And she's like, "No, they'll pick it up."
They even told me that. Because they have the exact same trash load as we do.
Right.
Well, ours says Air Capital. Because Waste Connections bought out Air Capital,
Right.
and so we still have the Air Capital trash can. But they have Waste Connections too.
I have
so.
2 trash cans that don't go to anybody's trash service in the city. It's gone into still dump them.
Who, Lee's? Is it Lee's?
No, they're just companies that have been gone for 10, 15 years.
See, I have 2 waste management trash cans that are spray painted black over the logos.
They tell you to.
Yeah, yeah, and I can put them out and
Yeah.
pick them up.
'Cause I got
I
one
have
from
3
a
trash
garage
cans.
sale and
Because
I got
Kelly used to
one
work for Waste
from
Management.
when Ron
And
did
so
it. They
when
got it.
he quit, they never picked up the trash. We got our service for free when he
Right.
worked for Waste Management, but they never picked up the trash. Which we like it, so if we're,
I put one back
Yeah.
out and they won't pick it
no,
up.
they won't. Yeah, if we're like cleaning, cause like I did a bunch of spring cleaning and I had all 3 trash cans full for like 4 months, every week.
Right.
Just throwing shit away. Get out of that candy. No, I'm just messing with you. Here, you want something different? There's that. There's this. There's this.
The video of the little baby reaching over to grab something and telling no.
There's the
And
Butterfingers.
she looked like the kitty that was on your chair earlier trying to get by your
Did you ever find any of those marshmallow
Not
Butterfingers?
yet.
I
Not
haven't
yet.
either.
Are you boarded on this
No, I buy it for the tax season. Every year. And I go through all of it. That usually what, by Easter I buy them more?
Yeah, you
Yeah.
usually take advantage of the Easter sales.
Yeah. Yeah, grab what you want.
I do.
I saw Matt over here into the mound. I still have not bought any almond joy yet because Shane told me if I do. He'll get mad at me if I do because he knows that we won't.
Well, then really make him mad. Buy almond joys and black jelly beans.
Oh, I know.
He won't come in
She
the
can't buy
office.
back jelly beans because she'll eat them.
Yeah, I eat them too. It was a big thing with me and Brenda and Shane. Every year, all three of us got them.
Let's begin that.
No, we got our own back. What?
Those are
Bigger
bigger
bags.
M&M bags than the normal.
Those are
Snack
the
size.
no,
No, they're fun size.
they're the fun size ones.
They're still a no-no for a lot of us, but
All
we
I
do it
know
anyway.
is, all I know is Fetch had it where if you bought so much in M&M's, Twix,
Oh, I use Fetch too.
yeah, and if you bought so much money in M&M's, Twix, but it had to be the Halloween, you got so many points. And so that's why I got M&M's and Twix, and
Well, but I can't use my government benefits to get none of that back.
I know.
You're trying to save up for a gift card.
Dude, I already hit it. I did a first time Uber ride and got 53,000 points. Yeah, because my husband and I went to go see Gabriel Iglesias 2 weeks ago, and Fetch had a special for Fetchtopia for October. It was October 22nd through the 28th, when his concert was the 25th. And if you were a first time, never used before Uber, which you haven't, you got 53,000 points. And yeah, that's,
Yeah.
so yeah, I'll show you.
That's awesome.
So I actually got more than that though.
I don't do everything. I don't do everything, but some.
Okay, so I got from Uber, I got, and then I got, down here, I also got like 100 points. Oh, dude, no, you have no. Look at Walmart. Look at that. Or, but, okay, that was the, that was for doing it Uber the first time. That one was my Uber ride, that one was my Uber ride. Yeah, well, I had never, and there it is, right there, another 100 points. I had never done it, so I clicked on it through the Fetch app, set up the app, booked my ride, and got my points. Oh, I know what I was gonna show you. Check this receipt out. Now, I will tell you, I had to tell Shane this, watch your points when you're doing it, because I scanned in an 11,000 point receipt, and all my other points disappeared. Yes, right there. My points, I had like 6,000, 4,000, or 5,000 points, and then I scanned in this receipt right here, and my points dropped to 11,500 or something. And I was like, so I contacted support, they fixed it, but check out that receipt.
All right.
I
So,
almost
what's
think
the
I
primary purpose of using the Schedule E? Well, it's pretty simple.
Be
The longest one.
when in doubt. Typically.
Because it covers a lot of things. It covers rental income, royalties, all sorts of other things. Which of the following is considered a passive activity? Rental real estate activities. It's an investment. An investment is typically passive. Which form does a partnership issue to each partner showing their share of a income or loss?
Those are for silent partners also, right?
You know, partners are partners.
Partner's a partner.
Well, we know it's a K1 since there's only one up there. They were very nice to you. 1065 is the partnership return, but we're using a K1.
It would be a passive.
Yeah, and there's a percent there's a number on there that would help you trigger the right
Right.
form.
Right.
Yeah.
You're talking about passive.
How does an S corporation get reported to shareholders? Again, B, I need a K1 schedule K1 from an 1120S. What type of property does rental real estate income typically involve? Both. We've talked about both. It should have been pretty straightforward. Where does one report income from royalties on a tax return? Schedule E. Since that was today's subject, again, pretty straightforward. If a beneficiary receives income from a trust, which form is this income reported? They made it a little bit more complicated for you this time. They put 2 K1s up there.
What is that stupid number out there?
Yeah, how is the character of income and deductions maintained through a pass-through entities?
See,
It retains its original character, whether active, passive, investment, business, ordinary, or capital gains. However it was for the entity is the way it's going to be for you on the personal side. The K1 is just its method of getting it to you.
the K1 will on the K1 it'll tell you what kind of income it is.
Because actually what the 1065 with the 1041 with the 1120S is just basically telling the IRS who's involved. Who got a K1. That's basically all it says.
This is what this entity did, and this is who's responsible for this
Right.
amount of money.
Yep.
Or this amount of loss.
What should be done with the net result of Schedule E?
I'll throw it in the trash.
Yeah. Screw it.
I don't know, I need that right off.
Go to Schedule 1, line 5.
Although this year not so
Which
much.
of the following is not typically included as rental income calculations? Personal use of a rental property by the owner.
Security deposit not returned to the tenant
Yeah.
is rental income.
Yeah, you got.
Right.
I
Unfortunately,
didn't read down on
yeah, devil's in the details.
Yes.
Yeah, that's like when you're doing your testing, right? Make sure
You read
you
all the
watch
possible.
for that double negative because they like to throw those in there.
Yeah,
And
because
then read all the responses.
Yes.
Yeah. and they're really good about saying stuff like 1099 NEC income is always put on Schedule C.
No.
That's false.
Nope.
1099 NEC income is not always put on Schedule C.
It can go on Schedule E.
It can go on Schedule E. It can
can
go
go
on
on Schedule
1040.
F. It can go on an F too.
Yeah, it can go just on your 1040 as other income.
Because farmers, when they sell their grain, they get an NEC from the,
Co-op?
yes,
Really?
yes, because I got one every year.
Because they're the one that's actually doing the sale.
Yes. They're
But-
just paying you.
Oh, they're the middleman.
Yeah, they're the middleman. They're the broker.
They're the broker.
Yeah, because they're the ones that can say, okay, hey, this corn's got enough moisture, we can give it to you at a higher price and use it as feed instead of this.
Yeah.
Which I
We
always
can use
like-
it as feed instead of ethanol.
Right. I always loved it when my corn had enough moisture that it went